So I'll be covering four companies for Q3 2022 earnings analysis. And the first company is Laurus Labs. So what I've done is basically looked at Laurus Labs on a quarter-over-quarter basis, compared this quarter's result. And I've also looked at how the Laurus Labs result look like on a longer time frame of a 10-year kind of a review. So very high level, sales this quarter declined 14.5%. Then if you compare this quarter's result versus last quarter's, that was a 14.5% decline. But if you compare this quarter's result versus December 2020, there was a 20% decline in top line. Profits also declined 17.3% quarter over quarter, and then 33% versus year over year. Margins are also going lesser. So you have 28% margins for December 2021 versus last year, same quarter, they did 33% margins. And there are a couple of reasons behind this. If you look at the quarterly sales, March 2021 was when they reported the highest ever quarter, which is 1,400 crores. This is the highest that they have done in their entire listed history. Now, 4 quarters, we have a sequential decline. So from 1,400 crores, we are now at about 1,000 crores per quarter. Now, the main reason for this is that they have the ARV part of their revenue, which is almost 50 to 60% of their entire revenue pie, that has been on a very high sequential decline. In the reasons that they have given is that there was a large stocking in COVID period. So December 2020 all the way till March 2021, their customers were kind of stocking up ARV APIs, and then later on they don't need it that much. So that's why there's a structural decline. But they also guide that this will go away soon. Now, one of the reasons that I have noticed from their con call is that they said when things were going up, let's say from June 2020 till March 2021, they never said that this was because of extra stocking. But now suddenly the story has changed. So that's one area that we kind of have to look at and be skeptical around as to if things will really pick up in Q4 or not. And the best way to answer that is to wait for results. So nobody really knows if things will happen. But if in Q4 there's again a sequential decline, then we have to kind of revisit the story and thesis around here. So yearly sales, if you look at from 2014, which is when they became, so they became public around, I think, 2017, but we have 2014 onwards data. There's a structural uptrend, and the major kick in revenues that happened was from 2020 to 2021. And the reason behind this was their capex coming online for formulations. The same story is kind of playing out now. They have done large capex in FDF and building capacities for other kind of APIs which are not ARV. So they call this non-ARV APIs. And most of this is now going, this capex will come online in some quarter next year. So there can be another kind of this bump in revenue, sudden bump in revenue when this kind of capex starts coming online. If you look at the operating profit trend, even though we had sequential decline of 4 quarters, the operating margins have kind of relatively stabilized. So from 33%, we have only gone to 28%. And the main reason behind this is their CDMO business is kind of picking up. And CDMO is a higher margin business. So it's growing almost at a 40% quarter over quarter. And at some point in time, that's going to become a large percentage of your revenue pie. And once that happens, your margins should stay above 30%, considering most of your or half the revenue will come from high margin CDMO business. Now, ability to sustain these margins, like I've mentioned, depends on the sales from their new capex, which is in finished dose formulations, growth in other API capacities, ARV sales at least coming back up, if not the highest level of March 2021, they're coming back to some level, at least even 50% of that, and the growth in the CDMO business. In the short term, there are a few triggers. So I've divided them in the base of short term, medium term, and long term. In the short term, you have the growth in ARV top line. So ARV top line needs to stabilize itself, if not continuously erode. Once it's kind of stabilizes and picks up, there will be pump up in revenues and whatever capex they have done. So in quarter, I think in this quarter, some of the capex will come online. and most of the capex comes online in FY 2023, which is the coming financial year. In the medium term, when the full capex of FDF comes online, that's when another bump in revenues will happen. And CDMO business, once it kind of reaches in critical scale, which will happen sometime next year, in 2024. So in that time frame, you will start seeing more revenue and bump up in revenues coming online, which is what they say they combined of these two will help them achieve $1 billion in top line. So we need to see if that happens or not. In the long term, you have contributions from Laurus Bio, which will reach scale after FY25 or sometime around FY25. CDMO business will become, as soon as it becomes 50% of top line, your margins may even improve. If not 30%, 30% can become maybe 35%. And the last trigger is demerger of three businesses. So this will happen eventually. How soon will it happen? I don't know, but I believe sometime in the next 3 years, there should be a demerger between the bio business, the CDMO business, the synthesis business, and the API business. That was my presentation on Laurus.
Right. So Saket and Sahil, do you have any questions? So I have 1 or 2 questions as well. So if you guys want to ask, you can go ahead. Right. Saket and Sahil, am I audible?
Maybe you can go first.
Yeah. So no worries. So just one question, Tar. So in terms of the way the mix is shifting in the case of Laurus, do you think it is going more towards the Dr. Reddy's way, or it is going more towards the DV's way, or what do you think basically of that? Because currently CDMO is still 12 to 13% of the pie. It's not like 30-35% types.
Yeah, I think it's going a Dr. Reddy's way rather than DV's. The main difference is DV's, first of all, can command higher margins and higher pricing because it's in niche category, it's the world leader, and it doesn't really have any competition around it. And they don't compete with their kind of clients, customers' product. So that allows them to kind of command or have some sort of a pricing power. So whenever inflation kind of or raw material kind of inflation comes up, they can still go ahead and raise their prices without really hampering their sales growth. Laurus is not doing that. Laurus is kind of trying to become a more diversified pharma company. And in some of the old interviews of Dr. Chava, you will hear him speak that his kind of a role model has been Dr. Reddy. And given his past history with Dr. Reddy's, he was an employee there. He started there, went on to work with other firms after that. But I believe that he's trying to build something similar of a Dr. Reddy's or kind of build a global large-scale pharma company out of India. But I don't think that's going to become like a DV's. So I don't think they will ever have like 40-45% margins and just stay within APIs. I do think they will kind of do everything within the pharma gambit.
Right. And just on the Saket, please go ahead, please.
Guys, if I'm not wrong, even Dr. Divi was working with Dr. Reddy's, right? So there is a Dr. Reddy's connect with all these companies.
Yeah.
Right.
I think if you go back in history, I think most of the pharma when they started was Dr. Reddy's. I think most of them can trace back to that.
Right. So just like in terms of potential risk or antithesis, one of them. So suppose if the ARV tender cycle doesn't pick up even in next 3 to 4 quarters. Yeah. So what do you think? Like, do you have that kind of a visibility on based of your reading?
I based on what other ARV, if you look here at Aurobindo and other guys, they keep mentioning that they see some of the headwinds going away. But I am a bit skeptical. I always like to be a bit skeptical because like you should always have your downside protected. So I don't know if I can trust yet. I want to see Q4 numbers. If there's an uptick in ARV sales, then even a slight big uptick will make me kind of believe that, okay, headwinds have gone. Till now, because last year they were guiding that there's no stocking, everything's going fine. This is not COVID related tailwinds, all of that stuff. When they clearly knew that, okay, this is excessive demand more than normal demand, they should have said that this is because of stocking. So that kind of makes me skeptical. But if in the short term there's a decline in ARV revenues, that's a significant risk, because your CDMO revenues and FDF revenues will not come up as fast as that. So that will get pushed on. They only happen sometime later half of this year or early next year. So if there's a significant decline in ARV revenues, then you will see top line kind of eroding. And considering the hype around this name, most people have it and they kind of love it to an extent that they will, like some on Twitter, a lot of people say that one person, one company, you will not sell no matter what happens and whatnot. They quote this company in Indian name and compare it to Tesla and whatnot. That kind of makes me a little bit nervous, because you should never, I personally don't like falling in love with companies. I'm here to make money. These are just instruments for me to make money. So as long as the story is fine, I'm okay. But if the story kind of sways in either direction, I probably will kind of reduce or at least have some hedges in place.
Right. Sahil and Saket, do you have any question, or we can go to the next presentation?
Hey, one question. I think in the medium term, there is also a risk of new therapies, right? Injectables, I think, if I remember correctly. Yeah. And like, any views on that? Like, is Laurus geared towards that challenge? Like, how would they face that challenge in the medium term or long term?
So injectables, so I believe even if injectables come, like let's say next quarter, if they by some miracle injectable come through in the market, I don't think they will be as cost effective, or even if they're the same cost, the logistics around injectables is much more heavy, cost heavy compared to just popping a pill. So I do believe, and Laurus is in the world the lowest cost producer of ARV APIs. So the DVs kind of, if you look at the DV story, what happened is when they were producing those APIs, they kept on refining their process, which kind of led them the lowest cost producer. And because they were lowest cost and able to sell lesser than what other people were able to, they pushed out the competition from the market. So as soon as the therapy kind of changes, other folks who are in the world that are producing ARV APIs, they will be the first to get knocked off rather than Laurus. So I believe Laurus will be the last man standing when it comes to the old therapy.
Yeah, makes sense. I have similar views. Yeah.
Cool. Great. Sorry, just 1 second. I will open my door.
No worries. Take your time. Sahil, till then you can start with your presentation on the results. So let's have you present on one of the companies.
So yeah, hi everyone. Let's walk through a few select companies and updates on those companies. So first one is Angel One. So just to give a quick primer to anyone who might not know, like this is a broking company, and essentially they're a discount broker. And the thesis is very simple. They're growing very fast, especially in tier 2, tier 3 cities. And we can see some of that in the quarter-on-quarter growth numbers. Any kind of numbers you look at, like it's growing exceedingly, blazingly fast. All of it shows up in the way that the revenues are evolving, client base is evolving, number of orders is evolving, and PAT is evolving. An interesting thing to point out is that very recently they've started giving out ARPU numbers, average revenue per user. And even though the ARPUs are falling, the margins are not falling. And what they're saying is, like, basically these incremental users from tier 2, tier 3 cities, they don't trade that much, but acquiring them is also not that costly. So essentially it does not dilute their margins. So like we might see that the user base is expanding much faster than the revenue base, but then the PAT will expand faster than the user base because the margins won't fall. Yeah. So that was about the short term. Let's look at a couple of things that Angel talks about in terms of their long-term like outlook. So one thing is people quickly point out is that, broking is cyclical. We need to be very careful, and that's very true. Like broking is cyclical, but Angel has pointed out some data. Like this is just one slide that I picked on Angel's own data, that like whenever we see falls in Nifty, even though these are basically corrections, these are not like bear markets. But whenever there are these corrections, you can see basically in column 3, column 4, column 5 that like Nifty midcap 150, Nifty midcap 150, Nifty 50, and Nifty Bank are all falling. Despite that, mostly Angel volumes just keep going up. Like the canonical example being, even if you look at the March 2020 fall, where like between 12 February and 23 March, there was a 37% fall in Nifty. Angel volume still went up 19%. So, I mean, it's sort of like our prior experience has been that whenever there's a prolonged bear market, definitely brokers suffer. But at least on these short ones, it doesn't look like they suffer. So we'll have to see like what happens. So one interesting thing to also note is in the earlier cycles, what used to happen is these brokers used to rely heavily on the order value, not the volume. And now basically because of the flat fees, what is happening is basically their revenues are correlated with the order volume, not the value. So like Nifty could be at 10,000 versus Nifty is at 7,000. As long as the volume is the same, their revenues will be the same. That's another thing to keep in mind. Another thing to look at for the longer term, I've picked one specific thing, is how their revenue base is evolving. So what we see, there's exactly one thing here which might not be very visible, that is a distribution revenue. That is what we need to pay most attention on. Everything else is mostly cyclical and around broking. Distribution is the one that is sort of not that cyclical. This is more of, distributing financial products, lending products, insurance and so forth. And the other thing is distribution is extremely high margin accretive because you have already acquired the customer, you are cross-selling to that customer. So any increase in distribution revenue directly flows to the bottom line. There's very little incremental cost that Angel has to bear for it. So on that front, another thing to keep in mind is they're also launching a super app recently, and they have paid a lot of attention to user journeys. And like how would they ensure that users that want to invest also have a good journey, not just the ones that want to trade. All of those are things they're thinking about. They've actually hired a lot of people from leading tech firms like Google. So let's see like how it pans out, like how their super app pans out. A third thing to keep in mind is that they have also applied for an AMC license. So they also want to launch some smart beta products. Smart beta is essentially, it's still algorithmic in nature, but I mean, it's an algorithm, so that's why like smart beta. There's no human in the loop. Yeah, that's all I have for the first company. You're muted, I think.
Right. Yeah. Great. So Saket and Tal, do you have any questions on angel broking? Right. Any thesis, antithesis question, or any data point that you'd like to add?
Yeah, sure. So I can get started. So one of the questions is like, in this business, it's kind of become race to the bottom in terms of whoever can give the least, charge the least. So I remember like Kotak, I think recently has announced a flat monthly subscription. They are not charging per trade basis. You can trade as much as you want, and it's kind of become a monthly subscription kind of a business where you pay Kotak a monthly subscription and they let you charge and do whatever you want, how much ever trades you want. So around that, do you believe that this can come and kind of affect the margins or can have some sort of an impact? That's one. And second, in their AMC kind of a license, if you look at Navi, it has also started launching passive and ETFs and mutual funds compared with in partnership with Vanguard. And I was checking out the expense rate on it. I think SDFC Nifty ETF used to be the lowest at 0.1. Navi has come up with 0.06 expense ratio. So both of those combined, you feel that there's at least some amount of impact?
Yeah, thanks. Wonderful questions. Let's look at the first one first. And instead of me answering it, I'll let the CEO of the largest broking answer that. So Nitin Kamath actually tweeted about this. I didn't ask him to, but he just ended up tweeting about it. Many people ask me if broking rates can go to zero like in the US and why not. Essentially, if you read through this, what you'll figure out is basically in the US, a lot of other avenues exist for brokers to monetize their user base. For example, they sell the order book to HFTs and so forth. All of that SEBI doesn't allow in India. So yes, people can bleed for some time. And basically, if you hear any interviews from Nitin, any interviews from Angel, what they say is that the competition is not on price anymore. It's actually on user experience. So that's basically what the brokers are saying. And personally, I'm also a little worried about that. I have seen some other competitors also launch that. I think Dhani launched something similar to that. So let's see like how it turns out. I'm also like keeping my eyes and ears open on that one. The second question you asked is about ETFs, right? So a couple of points there. One is that for sure these index ETFs absolutely are like a volume game, right? As the largest volume player will have the lowest costs, amortized costs. For example, Vanguard, right, being the canonical example. I'm not sure if that is the game Angel wants to play. Actually, it looks like the game they want to play is smart beta products, which is there is still an algorithm that is making decisions. So basically, it's still able to generate alpha. So the name is a little misleading actually. Even though the product is called smart beta, it's actually generating alpha. So the only thing is, since it's a algorithm, you probably don't have to also like you don't pay coders as much as fund managers. So like hopefully they can get hopefully they can get away with a lower expense ratio, like something in between index funds and your 2-3% to AMC managers.
Cool. Okay.
Right. Saket, do you have any question?
Yeah. So Sahil, just one quick question. Right now, obviously because the addressable market is quite high, and we're seeing a lot of these players coming in, likes of let's say a Zerodha or a Upstocks, to let's say traditional AMCs getting into brokerage, or traditional banks coming out with these plans like Tar mentioned. So how do you think let's say in some level is gonna be a differentiator for let's say Angel or someone to get to win in this space? Like, I know it's not a winner takes all, but there can be multiple winners. But how do you see this I would say an edge or a differentiator for Angel One versus let's say some of these other players?
Right. Thanks. I mean, wonderful question. Like, what's your right to win, right? And I think one thing to keep in mind here is the recent acquisition of Narayana Gangadhar. You actually hear him talk about 4.9 and 5.9 reliability of the app. So he's actually thinking about how to build like for the user, for the customer, and keep the customer in mind, keep the user in mind. They want to build their broking app in like all Indic languages, not just in English or Hindi. So they're taking a lot of those customer friendly, user friendly things. But you're absolutely right. It's not a winner take all. Another thing to keep in mind is basically different brokers are able to differentiate through things like what they offer to the trader, right? Because right now most of the revenue base is the trader. So in that, basically what I've seen is a lot of traders tend to prefer Angel. Some of the other brokers are not that trading friendly. For example, Zerodha does not give as many facilities as Angel. That's why they're able to gain market share. But another thing to keep in mind is, despite this structure, it's essentially still very fragmented. So there's definitely a lot of room for more consolidation. And like Angel is already, I think, in top 3 or 4. I would suggest like it would probably remain somewhere there in top 3 or 4.
Yeah. I think after Zerodha, or even compared to Zerodha and Angel, I think are the only two ones that are very tech heavy and actually using tech to do broking.
So Sahil, just one question from my side. So when we look at something like an ICICI Securities, so how will you stack Angel One against ICICI Securities? Because they are also talking about getting into distribution of financial products. They're also spending a lot on tech. And so that is one thing just for me to understand that. Right.
Yeah, thanks for the question. Good question. ICICI Securities, because of the fact that they're a bank-backed broker, have a very strong user base of HNIs and basically people with a lot of money. So their user base is very profitable. That reflects in the profit margins. If you look at ICICI Sec, they have, I think, 70-75% extremely high profit margins, operating margins, versus Angel, which might have like 30-40% operating margins. I forget the exact numbers, but it's very clear that ICICI is much ahead on that front. But I think some of that also makes it like a big elephant, so it's slow to move. Among all the bank-backed brokers, ICICI Sec is probably the most ahead. I think still they are behind Angel and Zerodha when it comes to tech, basically. So yeah, that's how it stacks up. But an interesting thing you'll see is literally every broker now is a discount broker. So there is no such thing as a discount broker. Everyone has to do that in order to survive.
Yeah.
Right. Makes a lot of sense. Right. Yeah. Saket, if you want to share the presentation, so you can.
I'm going to be taking you guys through a few of Q3 results for a few companies. These are the 4 companies I'm going to be covering. So let's start right away with Saregama. So, for the past 1 month, we've been seeing the stock declining, and, that's the small picture. I think in short term, this is what everyone's interested in knowing as to why the price is declining. Again, I don't have any answers as to why a price declines, because, there are always buyers and sellers in a stock. So if you actually zoom out using a lens, this year has been quite interesting for the stock. It has actually probably gone up 4x, right? When you compare to, let's say, what the price was a year ago. But, let me just jump right into the key takeaways for this quarter, right? And typically what happens is, if you look at the revenues of Saregama, and, for people, I'm assuming, let's say, for people, let's say, who are listening about this company for the first time, it's a music label that makes money every time you listen to music. Or let's say the IP rights, or let's say if the music which is owned by Saregama is used by someone, let's say in the form of a YouTube video or consumed on Spotify, or let's say you're making a reel on that music, it gives the company an opportunity to monetize that, because thanks to internet and thanks to companies like Google, Apple, and Spotify, it's actually now quite trackable to see how much music, or let's say how many times a particular, let's say, format of IP is consumed. So that has suddenly made record labels, not just in India, but globally, relevant in terms of understanding how they can see how their content is being used and monetize it effectively. So whenever Saregama reports its revenues, so the music, so they have multiple segments. So they have a Udly films division, which makes web series. They have a publishing business, which makes a small loss. And if you look at their music revenues, the music revenues actually has 2 parts. So they sell something called Caravan, which is a stereo audio box, which contains around 5,000 retro songs. And right now they are coming out with extensions of that product in terms of, let's say, Wi-Fi enabled products, which can, let's say, give the option to a user to listen to podcasts on that device. But what happens is, when you look at the music revenue on a quarter by quarter basis, this typically has the Caravan sales as well as the licensing income, right? And somewhere the metric that one needs to really track when you're looking at Saregama is how the licensing income is evolving, because that is where A, the scalability is, and B, the profit margins are. So if one were to really calculate Caravan realizations quarter on quarter, so the company doesn't disclose what the licensing revenue quarter on quarter is. So as an exercise, what one can do is, on an annual basis, they report what their licensing revenue is. So if you subtract the total music revenue, if you subtract the licensing revenue from the total music revenue for the year, you get the Caravan realizations for that year. And quarter on quarter, they disclose the number of units that they've sold, right? So let's say if we look at the past 3 quarters, you can see, let's say, the number of units that the company has sold every quarter. And this number is also disclosed at the end of the year. So when they disclose their Q4 FY22 numbers, they will be saying how much money they've made through licensing. So right now, what you see in the screen, it's a back calculation basis the average realizations of last year's. So what I've done is, for the purpose of understanding whether the licensing revenue is growing year on year. So you start with the annual revenues, you reduce the licensing revenue, you arrive at what the Caravan realizations are, and you divide it by the number of units to get an average realization per unit of Caravan. So when you put that number to see whether there's growth, so the company has actually been growing year on year on the licensing front. Roughly, this is like a healthy high double digit, somewhere between 20 to 23%. The management has guided that they will be growing almost 25 to 30% going ahead. And at some level, I do expect that this momentum will continue, given the fact that they've recently done a fundraise and they've already started deploying. So recently they've announced an acquisition. There was a label called Mango Music. This is again a Tamil catalog that they acquired. So in some level, that is, let's say, where the growth will come in going ahead. So as listeners of music, we might get fixated in, let's say, one language or one or two languages. But at some level, the real growth rate, and this is what Vikram Mehra, who's the MD, and they've told multiple times that the growth rate will actually start coming in, and the company will be able to match this growth rate once they are able to capitalize well on the regional markets. Now, what this leads the label to do, right? So at the end of the day, the label also has to negotiate with multiple DSPs. So DSPs are digital service providers, say the likes of a Spotify or a Ghana or a Reso. So multiple platforms are there which distribute your content alongside YouTube. So the more, let's say, you have catalog strength with you as a label, the better your negotiating power is. When Spotify came to India, they had put the entire catalog of Saregama on their platform without licensing it from them. And then, then there was a legal battle and Saregama won that legal battle. And then they had to enter into a licensing deal with Saregama, in which they were able to negotiate a better payout per stream, right? So that's some context with respect to the business. Going ahead, there is a big roll-up play. What I mean by roll-up play is how efficiently, let's say, the label is able to enter into these regional markets, get share, and roll it up into the actual label, which is the core label, which is Saregama. So that will ensure that the catalog strength stays relevant. At the same time, you get better negotiating power with DSPs. Now, having said that, there are also certain risks, and if one were to put a crystal ball and try and see how the future could look, there could be some, let's say, challenges with respect to the profitability of the business. So right now, you're seeing, even if you compare, let's say, the revenues of last 2 years annually, what has happened is, because retail stores were not open, so the Car1 sales had actually dropped. But what you'll see is the operating profit margin has gone up because the licensing revenue kept growing. So even though you saw the top line was flat for 1 or 2 years, but the margins actually expanded. Now, going ahead, as we see things open up and, let's say, Saregama doing more content acquisitions, you could see at some level the content costs spike up a little. And at the same time, let's say, if the renewals do not happen with, let's say, a higher pricing power, or let's say at the same rate, that could also affect the profitability in some way or the other. Now, in our entire thesis about this company, we've not factored in anything with respect to how the paid subscription growth kicks in India, because globally, if you look at, let's say, how Spotify makes money, a bulk of their revenues actually comes from paid subscriptions than ads. So that trend is yet to really take off in India. Whenever that happens, that's on top. So that also in some level can affect the profitability of the business, right? Now, there are also, let's say, some concerns with respect to capital allocation, because typically what happens is when you raise funds and you tend to do acquisitions, there is also a chance that you can overpay for certain inorganic opportunities. So up until now, they've just announced one acquisition. We'll have to see how this pans out going ahead. So that also remains a risk. And there are certain, let's say, accounting related things with respect to the business. So there are certain cross holdings in group companies. They have a publishing business which can be moved out. So there are these things which are related to capital allocation for the company. And finally, with respect to valuations, so because the company has run up quite, the company has run up quite highly in the last 1 year. So with respect to, let's say, how do we see a PE compression going ahead, right? So if they are able to continue with this growth momentum, so this is almost 25-30% is what the management is guiding. So if this is continued for 2 years, we can look at just the licensing PAT at almost, let's say, 300 crores 2 years out as on FY24. So that at current market prices gives you the stock available today at a forward PE of 27 times earnings. So in case this growth rate slows down, you can again see compression with respect to the price earnings multiple coming in, which can lead to valuation derating. So that's it.
I think, Saket, you should also cover tips as well. Then we can combine and ask questions on the entire music industry.
Yeah, I'll do that.
Right.
So yeah, that's with respect to Saregama. Now let me jump into tips. Again, similar line of business, but the reason why I like this company also is to do with multiple things. Now, one, obviously, tips gives you an opportunity to invest in a pure play music company. Whereas in Saregama, you have different other businesses with respect to, let's say, Carvan, their publishing business. Then you have the OTT platform, OTT production platform. So Tips had a legacy films business, which right now they are in the middle of the process of demerging. And what has happened is the traditional films business typically involves big stars. So there's big budget, money spent, and you really don't know whether you'll be able to recoup that money or not, because there is massive risk that you carry with such big budget movies. Now, what has really changed in the last 2 years with, let's say, all these theatrical releases not happening, suddenly all these production houses had to rely on alternative sources of revenue. And at the same time, because a lot of people were at home, suddenly OTT consumption became mainstream. So suddenly all of these OTT apps that mushroomed all around us, they had to foresee how they can, let's say, acquire content which is relevant, right? So even Tips was in the process of producing a movie called Bhoot Police, which had, let's say, all the A-list Bollywood stars. But at the end of the day, that ended up getting sold to Disney Hotstar. And they were able to make a profit on this, compared to, let's say, if they would have gone for a theatrical release, you would not know whether they would make money on that or not, because that's a risk you carry as a producer. So the core business, the core pure play music business, is actually showing phenomenal growth for the last 3 quarters. If you see, the year-on-year growth has been higher, almost 30-40%. As on Q1, Q2, it was as high as almost 70-80%. But that's also to do with the fact that last year the base was a little smaller. At the same time, they entered into a global distribution of their content partnership with WMG, which also happens to be the 3rd largest music label in the world. So there is lumpy revenue. Sometimes there are overflows, from one quarter to the other. But as long as the growth keeps kicking in, I think music labels have a long way to go, because content consumption is exploding every day as we go ahead and as time passes by, right? Right now, the company is also in the middle of a special situation. So there's a films demerger that's happening. They've guided that they'll close this by Q4, if not by early Q1. So let's see how that pans out, because it's also subject to regulatory approvals. Unless, let's say, there's a new wave of COVID and courts again stop functioning physically, we might see delays in demerger happening. And as far as their content strategy is concerned, they've increasingly focused on recycling content. So if you check out their channels, you'll see they'll republish or remake some old song. Recently, they did an ensemble of recreating all Jagjit Singh's tracks. So they keep doing these things. So at some level, let's say, we don't see the content cost spike much, but that's also to see how that evolves going ahead into the future, right? So as I said, there is a risk with respect to whether if there's a delay in demerger, because what happens is right now, because the films business and the music business are clubbed together, there is, and at some level, if you see why a business doesn't get the PE it is supposed to, or the multiple it is supposed to, because at some level people have this fear that there could be capital misallocation at the company level, right? Because you could be using the money from the music business, subsidizing it on the films business, and burning money there. So as long as that clarity is not there, we might see this as a potential risk going ahead. And again, this OTT versus theatrical releases is what we discussed. Now, as far as the valuations are concerned, if they are able to continue on this growth momentum, again, FY24, the licensing pad could potentially be 150 crores, which makes the stock available at a forward PE of 17 times earnings. Similar antithesis pointer with respect to Tips, as we saw with respect to Saregama. If you see a slowdown in growth, which could be with respect to, let's say, consumption of content, how people are consuming content on OTT platforms, so on and so forth, there could be a compression in the price earning multiple. So yeah, that's it from my side, guys. If you have any questions.
Yeah, Tar and Sahil, if you have any questions, you can ask.
Yeah, a couple of questions actually. One question that a lot of people have on music streaming is, to what extent are their fate tied to the telecom rates? Like if, because telecom sector is consolidating and they're increasing, they want to increase their ARPU.
Sorry, their fate tied to, I lost you in between.
Sorry, what I was saying is, to what extent is the fate of music streaming businesses tied to the ARPU of telecom players, or sort of inversely tied to that? Because if telecom players increase their ARPU, they want to charge more per unit data consumed. Can that potentially lead to headwinds for basically YouTube and basically for all the music streaming players and content labels? That's first question. Second question I have is, I have done a little bit of sort of effort on figuring out the rate at which Saregama and Tips are growing their views. There's this website called Social Blade where you can check the views that they have at a YouTube channel level. I did that for like all their channels which are of significant size. Saregama is actually growing its views at 45%. It's pretty high. But one thing I still don't understand is what was visible in your numbers as well, that their music streaming is not growing quarter on quarter. So do you think there's some deal structuring here where like any incremental views get paid in a lumpy way? Is that what is happening? Or like, I don't know how to reconcile the data. Yeah.
So let me first start with the first question, Sahil, on telcos and ARPUs, right? So at some level, if you see, and this is, let me first start with how we've seen this evolution happen on the video OTT side. So today, while we can all debate how paid subscriptions will grow, at some level, the video bundling has already started. So today, if you take a Jio fiber or a Airtel fiber connection, along with, let's say, the data connection that you get, you're bundled with, let's say, a Hotstar, a Sony Live, at some level an Amazon Prime, and these are already getting bundled in your subscription for a year. And next year, whenever, let's say, you renew, let's say there's a 60% chance you will just let that renewal kick in, or you might opt out, right? But again, we are probably talking about the top 100 million or top 200 million consumers in India and not the overall base. As far as, let's say, increase of ARPUs are concerned for telcos, up until now, they've all struggled in really increasing their ARPUs. At some level, I do feel it's a factor of per capita GDP income, right? Because at some level, I mean, people right now are just getting used to consuming data the way they are consuming now. And honestly, that's got to do with what Jio has made it available for everyone at almost peanuts, right? So at some level, we'll see this catch up happen, right? So right now, I think all telcos are just concerned with respect to increasing their user base. I mean, different telcos have adopted different strategies. For example, Airtel says that, no, I'll just focus on my profitable users and focus on growing the ARPU. But let's say if, Jio tomorrow comes and slashes the rates again, at some level, you'll see all telcos will play catch up, right? So I think right now, I don't see ARPUs really going ahead. But let's say if they go up, right, it's not that the consumption habit that consumers have today at some level is going to change. So that's one. And the second question with respect to YouTube views. So yes, Social Blade is a great tool. Even I use it to track multiple things with respect to views. So I think, even in the YouTube's algorithm, you have something called CPM, which is cost per mile or cost per million. And that CPM rate is it's quite a black box for any creators, right? The CPMs are quite high if you look for, let's say, a publisher who's sitting in the West, but let's say a publisher sitting in India, the CPM will be quite low. So that's again an algorithm which only Google knows and how they work with. So with respect to why that revenue has not come in, I do feel that because still we are just seeing deals coming in. It's quite nascent. I think 2019 is when Facebook started with Watch. 2020 is when Reels came in and really became mainstream. And when TikTok got banned in 2019, and that's when short form as a format really exploded. So I think we're still very early to see whether we can see predictability over recurring revenues. But yeah, point well taken, right? There is at some level the numbers and let's say the revenues at some level don't add up. But I mean, if you zoom out and see, there is some change in how, let's say, a label would recognize revenues 2 years ahead and right now 2 years forward, right? So yeah, that's what I have to say on that.
I have a question around key men and like key artists kind of dependency. So Badshah recently signed up with Universal Music Group, and most of these, like at least in India, what I've seen, like either the songs are very movie heavy, movie industry heavy. There are some like they are there for maybe a week or two and then they die down, and some are artist heavy. So everybody like mostly follows Badshah and whatever is new releases. And I've seen this trend kind of play out where in the West, most music comes from pop stars and rap stars and music artists, and that's where the music industry is mostly concentrated at rather than movies and everything else. So what do you think, like what happens if like Western labels, what you mentioned that Tips also has signed a deal with Warner Music, and let's say Tencent Music or UMG or somebody else the big guys come in and they start lapping up and signing up all the artists, and is that like a major risk for these guys, because then they will be just limited to movie industry and movie music industry?
Yeah, great question. So India historically has always been a film music market. If people relate to songs, they probably don't know the name of the artist first. They probably know it that, okay, this is, let's say, a song related to Amitabh Bachchan or a song related to, this actor or this actress. And this is something which Vikram has told multiple times in his con calls for Saregama. Now, in the last 2 years, what has happened, because films were not releasing, suddenly the non-film category exploded in India. So you saw all these original releases from both these labels, right? And multiple labels. I think even T-Series released around 80, 90 original songs throughout the year. So I feel that in the last 2 years, what has happened is people have started really caring about music, and not because, there were no films in the first place. Now, once these films start to get released again, maybe we'll see that trend coming again or not. I mean, we don't know. But what has really evolved, despite films not releasing, is that the music category kept growing thanks to non-film music, right? So that is a trend which is very encouraging. Now, to your second question on, let's say, Badshah getting signed by UMG. So at some level, all of these labels have something called an A&R function where they manage artists and ensure that they get top dollar for their talent with respect to performances or albums or songs. So tomorrow, if Saregama wants to do a song with Badshah, I mean, they can go ahead and do it, right? But then probably their content costs will spike. So at some level, again, Badshah has been signed by the global catalog of UMG. Now, this was also a very interesting podcast that I'd heard, and Ishmohit had also shared it. Business Breakdowns is the podcast where they talk about UMG being the gatekeepers of music and multiple, let's say, economics of this business. We'll try and put a link to that so that our viewers can listen to it. In that, they do talk about the fact that a lot of these global labels, because let's say at some level they've matured on their growth rates in developed markets, they are looking to come into markets like India, right? Or let's say Southeast Asia. So even in India, right, we've seen these acquisitions happen. So Believe, which is a Paris-based French label, they acquired Venus Music 3-4 years ago. And I mean, just until last week, there was a label that they acquired, I think Music, for $15 million. So we are seeing these acquisitions happen. And at the same time, what is also happening is a lot of private equity players are entering into, let's say, deals with smaller labels where they say that, hey, let us pay you 5 times or 6 times price to sales upfront, and let us keep sharing recurring revenues that come on the upside for, let's say, the next 10 years. So there is a lot of global interest which is coming in, but at the core of the problem, you really need catalog, right? So they need content, but I mean, for labels like, say, a Saregama or Tips, they would much rather license the content than sell that content out, unless someone really gives them crazy money to buy them out, right? So even with WMG, right? I mean, they have all the wherewithal to have acquired Tips as a label. It's hardly anything for them globally, but they did enter into a content distribution deal with them, which also kind of shows that at some level there is some power with respect to negotiation with these labels in India, even though they are quite small compared to the global peers. And even UMG in its IPO document talked about the fact that in India, they have partnered with multiple labels. So if you see, there's a channel called Desi Melodies in YouTube, which has a lot of these hit tracks, like let's say Filhal by Biprak, done like 1 billion views. So even they have entered into partnerships with these labels. They've not gone and outright acquired them. So yeah, I think it's more of a win-win positive sum model rather than, let's say, a zero sum model for all these labels.
Yeah, that makes sense.
Okay, just a follow-up question to that. So some of these deals, are they exclusive or non-exclusive? Because we can see the likes of Bajaj even doing songs with other labels as well, in spite of signing up with UMG.
Yeah, so I mean, it depends on artist to artist. So in India, at some level, I mean, if you see, let's say, all Jubin Nautiyal songs come out of T-Series, right? Or let's say all Atif Aslam tracks used to come out from Tips because they had him for quite some time. So I think it also depends on an artist versus, let's say, a contract by contract basis. So Bachcha did songs with Saregama. Now let's say Jugnu was under UMG. That was the first track that UMG did independently with Bachcha. So I think it's more to do with on an artist by artist basis and how let's say the label is able to take care of the artist, or because we've heard this multiple times. Vikram talk about in Saregama's con calls is that they want to work with everyone, so there is no exclusivity per se. But at the same time, you also see some exclusivity somewhere. So Tips has signed up multiple new artists, so they are quite exclusive to the label again because they are very new or very small. So I think it's more to do with the commercial terms, but this is something which is a global trend. So let's say Drake is only with a label, or Ed Sheeran is only with one label. So that's more of a global thing. Might see that happen in India. One example that I can think of is Jubin Nautiyal and T-Series. You see all his songs come out under T-Series.
Right. Great. Any more questions, Sahil and Tariq?
Nothing for me.
Right. Great. I think let's move on from the music industry. So I'll just share the presentation. I think I'll also present on 2 companies. In next round also we can take up 2 companies. So I'll just present on Deepak Nitrite, and the second company that I'll present on is Navin Fluorine in the beginning. So chemical plays earlier. So just before starting, presentation is visible, right, guys?
Yeah.
Great. So yeah, so Deepak Nitrite actually reported the results. So like FY21 was a phenomenal basically jump off leap for Deepak Nitrite because phenol spreads increased, and secondly what ended up happening was that that they were running the phenol plant at a very high capacity utilization rate. And at this point of time, even in their fine and specialty chemical business, so Deepak basically has 4 divisions. One is basic intermediates, second is fine and specialty, and it's an integrated chemical company because basic intermediate feeds in as a raw material for basically fine and specialty chemical products. And then there is a performance product, which is a gruesome business because it has its own wild swings. And finally, we have the phenolics division. So in fine and specialty as well, last year in FY21, they had a phenomenal jump in profitability. In one of the quarters, they even reported 48% EBIT margins, right? And in basic intermediates, this basic intermediates used to be known as basic chemicals before. And in this business, some time back, like not so long ago, I think 5-6 years ago, they were just making 10-12% EBIT margins. But because of the process efficiencies and backward integration efforts they have taken, now even in basic intermediates, the minimum margin that they're making these days is close to 20% EBIT margin. And which seems to be interesting. And one of the other reasons for why do we see that Deepak Nitrite has a very, very high segmental return on capital employed is because the units in basic intermediates and FNS maybe are completely depreciated because they are a little old units. Because whenever I look at their return on capital employed, it's just off the charts. It's not so long ago in the phenolics division, they were reporting like segmental ROC of almost 60-65%. Similarly, in basic intermediates, the segmental ROCE was more than 50%. Even in FNS division, it was more than 50-60% types. So it's an integrated chemical company. And this time in results, what they reported was so this time, I think the results were a bit disappointing because they were also hit by the raw material cost inflation. And one of the things was that in terms of the margins was that in a company like Deepak Nitrite, you must track the margins very, very closely. So in basic intermediates business, so their margins decreased by almost 400 basis points to 20%. In finance specialty business, so year on year, the margins almost fell by 17% to almost 26%. Last quarter, they were close to 30%, right? In performance products, so again, because it's a diversified chemical company, जब कोई एक segment मरता है तो दूसरा segment आके बचा लेते हैं. So this time in performance products, they reported a margin of 27-28%, which was close to 9% last year. And so in the first 9 months of FY22, it is close to 16%. So I think this was FY22 first 9 months only. And in phenolics division, so because phenol spreads reduce, they reported an EBIT margin of 18% types, which was again a reduction. And secondly, because of increase in the prices of raw material and power and fuel costs, this also led to some contraction in the EBIT margins. So I think out and out, the results were not so great, little towards the side of underwhelming. But I think in terms of short term, medium term, and long term of the company, there are some extremely interesting triggers. So just to show you how basically the diversified nature of the business is, that when one segment gets bagged, then some other segment comes and basically saves the profitability. If you look at the profitability of basic intermediates, you can see it's reverting back to the 20% mean EBIT margins. Then there was a time in Q1 FY20 or Q4 FY20, as you can see, during the time when the prices of Dajda, which is their performance product, that really just went through the roof, right? The pricing, so they printed close to 58% types EBIT margin. But this, to me, is a very deep cyclical business, the performance products one. Even in Q3 FY22, again, as you can see, as the margins fell to 24%, now again they're back to 28% types. And next quarter, likely it will be even more blockbuster because prices of Dajda have further risen by 15-16% types quarter on quarter. Phenolics, again, phenol, it works on the basis of spreads. So again, they've fallen to 19-18% this time, and there was also inflation in raw material costs. This also led to some contraction. And finally, if you look at the finance specialty division, so this time, so again, they keep mentioning that in the finance specialty division, because they're exporting to a lot of European companies, so they need a lot of stability, but they've already taken the initiatives for hiking the price. So basically for passing on the input cost hike. So their long-term vision for maintaining more than 33% types EBIT margin in finance specialty remains intact, but I will still take it with a pinch of salt because we are living in a world where central governments are saying that there is no inflation. But when you look at results of companies, then you just see inflation, nothing else but inflation, because gross margins are just contracting like anything. Right. And actually, that is the truth, because bottoms up, if you look at a lot of results in B2B businesses this time, it's just widespread inflation everywhere. It's not like each and every sector has been spared, but a lot of sectors have seen this. So inflation is a reality. It's no more hidden. And I think these things too have cycles, right? So I think the cycle of downstream producers, like the profitability cycle of downstream producers has kind of value migrated to the upstream guys currently. How transient this is, how structural this is, no one knows, because these things move in cycles. But as the upstream guys also announced massive capex, right? So I think IIFL Finance Management mentioned in one of the con calls that they're seeing commodity companies doing a lot of capex. But actually that is true, because if you collate it to some companies like Deepak Fertilizers, they've announced a capex of more than 3,000 crores for ammonia. And a lot of other commodity businesses are also doing a lot of capex right now. So that seems to be true, but could be transient. Whether structural, I don't know. But this is the cost inflation is here to stay. So it's very difficult to foresee the stable. It's very difficult to foresee the stable margins in such companies. So what are the short-term, medium-term, and long-term triggers for the company? Short-term triggers are, suppose short-term triggers for me are somewhere close to next 4 to 8 quarters. Medium-term are somewhere close to next 8 to 16 quarters, and long-term is beyond 3.5 to 4 years. So in short-term triggers, see, phenol spreads have again started increasing. So prices of phenol have again went above 115 to 120 rupees per kilo. So if you track such businesses, you have to track so many things, because you need to know, you need to be on top of it, because it's not it's not something which is purely into value added. But if you invest in such businesses, then there is also this portion of risk and reward, because in last 2-3 years, earnings went from 100-150 crores to more than 1,000 crores. And the type of capex they are incurring. So currently they're in the process of spending 1,400 crores, and they've also announced a QIP. So last QIP they did in 2016 and 2018. From there, some of the institutions have made more than 25-30 bagger on their initial investments. So I don't think raising money will be a challenge, but how they deploy it, that is remaining to be seen. And short term, some of the triggers are DASDA pricing, phenol spreads, and some of the triggers on the risk side are volatility in raw material. Then IPA capacity has also doubled. I think 60,000 tons per annum is what their capacity is now. And in finance specialty, they have initiated the pass through of the pricing hike. Then one of the things to track is margin volatility. Medium term is that they're adding downstream derivatives of phenol, which have 150 basis points better margins than the normal phenol that they're making. So that is the long-term trigger. So they're getting into solvents as well. And then they're getting into new platforms like fluorination, photochlorination. That is for some, that is also for agro intermediates and pharma intermediates. And the one thing that is remaining to be seen is how they utilize the QIP proceeds. And one more thing to watch out for is CapEx in finance specialty and business intermediates division, because they mentioned in the call as well and in the separate interview as well that they'll be launching a large number of chemicals in both the divisions, especially in the finance specialty division. So that is something that is interesting to see. Long-term trigger remains that if EBITDA growth outpaces the top line growth in the long run, and whether they're able to sustain the margins or not, or whether they're able to become a more non-volatile player as compared to the volatility we see today. Right. So this is with Deepak Nitrite. So any questions, any like the three of you have?
So one of the questions I have, so usually when chemical companies, they move to different products, they usually do within the product that they are doing, either they go upstream or they go downstream around it. Now with Deepak, they have they do phenol, then they're trying to go into fluorination. So do you see maybe they will find some challenging into terms of the time taken to develop technical know-how into new chemistries, and that maybe can one of the risks for them. And because if you look at Vinati and all, they always have grown by either downstream, going backwards integration into their product and increasing margins, or forward integrating and upselling.
I think that's a great question. So this was also actually part of the next slide, that is Navin Fluorine. So I've been tracking the space very, very carefully. So I attended the call and they mentioned that in fluorination, so they'll be mixing their current capabilities of nitration and the other capabilities they have. So they won't be just entering the fluorine value chain, but they'll be using fluorine with other chemistry reaction capabilities they have to build basically molecules. And even in fluorine, so that will be used as a first or second step chemistry. So they are not going what Navin does, that is going 10, 15, 17 steps down the line just in the fluorine value chain, because that really takes, I think 20, 30 years to that type of master. So, but they are remaining to be seen, because one thing that is actually my fear as well in this industry is that when you see that, suppose if you talk about the fluorine chemistry, as you mentioned, the largest chemical company in India after Pidilite today in terms of market cap is SRF, close to 80,000 crores of market cap, right? And that market cap is also given because they have very good capabilities in fluorine. Then you look at the multiple being assigned to Navin Fluorine, and then you look at the multiple now being given to Gujarat Fluorochemicals as well. So all the chemical companies will try to get in that domain because the usage of fluorine is also increasing. So how much commoditized the space becomes, that is something that is remaining to be seen, and you have to actually do your checks and actually see कि कौन सा space commoditized नहीं होता है इसके अंदर, right? So then you have to be very, very careful with it.
Yeah, that makes sense, especially at the valuation some of these companies trade at.
Right.
Can't afford to go wrong.
Right. Sahil and Saket, any questions?
Hey, just one question. Uh, in your recent hospital webinar, you talked about how the high margins and high ROCEs generally attract more capital and competition, right? For example, Cayman Island, Narayana Hrudayalaya, I think, is the one that has a hospital, and then I think Aster is the one that wanted to set up and so forth, right? And similarly, we have seen this play out in some other commodity chemicals like I think ibuprofen, right? IOLCP and granules and others. So my question to you is like, why is it that Deepak is able to enjoy such wonderful margins and this industry is not attracting more capital or competitors? Like, is there a, even though it's a commodity, is there some kind of an entry barrier which prevents people from coming in?
I think if you just look at, so in finance specialty, basic intermediates, so the FNS and basic intermediates division, I look at it separately. Performance products and phenol, I look at it separately. So performance products may, one thing to be sure of is that some of the unlisted players, they make consistent 20% EBIT margins, whereas Deepak is experiencing wild swings. So I know one of their competitors, he's a very close friend of mine. So why is it so? Because Deepak is always going after market share in that particular division. So there are 4 or 5 main players in the country, but still dynamics are, it's a price taker. It's not a price maker over there. Similarly, when I talk about the phenol business, so phenol business they're competing with very inefficient competitors in India, especially. So one of there are 2 plants. One I think is at Haldia, if I'm not mistaken, and there is also one more plant which are run very, very inefficiently. One is owned by the government only. So apparently, from what I hear from the distributors as well, their quality of phenol isn't that great as well. But I think in terms of just import substitution, suppose if someone else wants to put up a plant for phenol, 1600 crores ka plant. So only for a petrochemical giant it makes sense, because you can easily forward integrate. But now if the demand of phenol is also growing at 10-11%, I don't see how not Deepak ends up setting a second plant for phenol. I don't see a scenario where they do not end up setting up a second plant. It's similar to what is happening in the case of Borosil Renewables, that you have to set up to capture the demand. Otherwise, you're leaving the white space for someone else to come in, right? So that is a very valid question, and that is a risk with the company. So that is why you have to track this very, very closely. So it's not something that you can just buy and forget. It's something that you have to buy and monitor like a hawk. It's not that type of investment. And you're totally right. Suppose if some petrochemical company tomorrow comes up and say that we also want to set a phenol plant. There is no difference between phenol. Ki wo Deepak ka phenol hai, iska phenol hai, because at the end of the day, it's a commodity chemical. So when they go downstream, then they use basically the capabilities from their finance specialty division or from the Deepak Nitrite business with Deepak Phenolics. That is when something more integrated they can create. But it's a volatile business. This is what reflects in the multiple as well. They get a multiple of 25-30 times, not something like Aarti Industries, which has lower margins, but still gets a 55-60 times more, like multiple. That is primarily the reason.
Thanks. Yeah, makes sense.
Also, this petrochemical conglomerate, right? For them, this could actually be quite a very small ticket size or a small opportunity size to even think of, right? If I'm not wrong. Because I've seen this happen with other chemicals as well, right? So there are a few companies which import those chemicals. Whenever you talk to them, they are like, yeah, if let's say this conglomerate wants, they can do it tomorrow. But it's too small for them to even think of it. So do you think that's the same case with Deepak and phenols and all these chemicals that they are getting into?
See, my fear with the thing is that suppose if Deepak gets a 1 lakh crore market cap, then it won't be small. Right? Then you can also see that market is basically valuing it for its import substitution capabilities and stuff. Then if you actually talk about large numbers, then it can really attract competition. But you never know. There's basically, I think they also have like good supplier customer relationship. So you never know what type of relationship they have. So that is also there.
I think this is a game of scale as well. Like whoever creates the scale for the first to reach the critical like giant capacity scale, that kind of wins the market, because the next competitor will have to come and set up bigger or at least competing scale, or at least 75% of the scale that it has, and overrun the market. And if you overrun the market with, let's say, phenol, for example, if you have a demand of 100 and suddenly the supply is 150, you're kind of hurting yourself. First of all, you have lower scale than the market leader, and then you're forced to kind of sell because you are kind of oversupplying it. So that's kind of, in a way, invisible kind of a moat kind of a thing, where if you reach the scale first and if the demand is stable, then I other people kind of think twice before coming in.
Right.
So Ishmohit, I had a question. See, I've never tracked this company or this space, right? Now, let's say there could be viewers who've, let's say, never seen this company. So what would you recommend could be like a good starting point for someone to see or read to understand this space, or let's say this company a little better?
I think one of the businesses, so they should just open the SOIC YouTube channel and just watch all chemical analysis. I'll just simply say that, because all our chemical analysis are like full of thesis, antithesis, demand, supply, everything, and the entire value chain as well. Especially the clean science one, the Vinity Organics one, the Navin Fluorine one, and especially the Deepak Nitrite one. That's a 1 hour analysis on the channel. So they can do that. And secondly, if they want to build expertise in this, there is one of the videos on the Tamil Nadu Investor Association channel. So that is just about the chemical industry, which is with one of the experts. So they can also watch that. That's a good source to get more information. And also read the annual report of Deepak Nitrite, the latest one, because that gives you a very, very good outlook of what the chemical industry is looking like and where it is going. And similarly, Aarti Industries annual report is also very, very good to just to give you an idea about the overall chemical industry. These are some of the sources that can be used.
Cool.
Right. So just moving ahead to Narayana Hrudayalaya, and then again I think Tar will also present. So Narayana, I think this time X of vaccine revenues as well. So 9 months. So if we just exclude that as well, so in 9 months, so this time the revenue, there was a jump of almost 26-27% as compared to last quarter, year on year. And 9 months, there was a jump of almost 62%, which is not entirely comparable because last year they were also hit by COVID as well. One interesting thing was that in terms of the specialty mix, this time cardiac sciences increased. So this was originally a like cardiac based hospital. So they have a very large hospital in Bangalore. I think Tar might have seen sometime or the other.
Yeah, it's a big one.
Right. Yeah. So I think results were very extremely interesting because all the hospitals are reporting some like tore-fold numbers type. Max reported today. They did almost an operating EBITDA of 350-360 crores. KIMS reported yesterday, which was interesting. HCG also reported, which numbers were good apart from one-off. So all the hospitals are doing good. Just before I proceed, one of the risks that I see with all these hospitals is, what if this is pent-up demands for elective surgeries, right? What if we get what if we get fooled at the end? That risk is there because from my checks, at least the bed wait time has reduced, right? The waiting time for beds has at least reduced right now. But why particularly I think Narayana has been doing well is that their new hospitals, so suppose Delhi NCR hospital that has just broken even, they expect it to turn EBITDA positive next year, and ARPOBs in Delhi NCR are really, really high because it is just, so I've seen this hospital, so it's close to the airport, like 15-20 minutes from the airport, and like it can attract a lot of international patients. And one more interesting thing all over the landscape this time in hospital results were that international patients still haven't come back in full force. Patients, so internationally, India attracts a lot of patients from Afghanistan, Bangladesh, and West Africa especially. So Bangladeshi patients have come back, but from the other two regions, the patients still haven't come back. If we include West Africa, I think Afghanistan might be some disturbance. So so that is there. And international patients have higher average revenue per occupied beds. Reason being because if they are traveling internationally, so obviously it's something which is difficult to treat in their country at a reasonable cost, or that treatment isn't available. So ARPOBs are higher. So that is there. And one very interesting thing this time which came to light was that I also track Aster. So like they do 45% EBITDA margins in their Cayman Island hospital business, 42 to 45%. And seeing this, because it was available in public, so Aster also announced a capex for Cayman, but they weren't able to source any equity partner or land partner, and they shelved the plans. And just before they shelved the plans, Narayana, as a part of business strategy, you have to protect your overall profitability. They also announced a greenfield capex in Cayman, close to the airport, where they're setting up oncology blocks. So oncology is also interesting business, but I think this capex had to be done to basically deter the entry of competition, like you mentioned for phenol, right? So real world, this is a business strategy competition. It's like a game of chess where you can see what your competitor is doing 3 years out. Then you also have to like basically make your move very, very carefully. But one very interesting thing in the con call was that he mentioned that if they do not even do any capex, just through efficiencies, they can manage the volumes and they can grow for next 3 years. This was one of the data points which I really sort of liked. And he also gave a very granular breakup of all the brownfield capexes that they can do. So oncology blocks they're setting up, then they can add 20-30 beds in almost all their hospitals. And even greenfields that they'll do, that will be in Bangalore and Kolkata, because those are their biggest hospitals. So hospital may we sort of try to classify it into different categories of capexes. First, cheapest subset return accretive is brownfield, then greenfield within the same city, because whenever you go to a new region, you have to build your brand, right? Now, suppose if Kim's Hospital comes and sets up a hospital in Delhi, लोग कहेंगे Krishna Institute किसने सुना है, right? Delhi किसी सुना ही नहीं. Similarly, if you talk about BL Kapoor, so BL Kapoor Hospital in Karol Bagh, initially 5 years was very painful. 5-7 years is minimum required to go to a new geography, build a brand, get more patients, attract good quality doctors. That is a minimum requirement. Yes, in Delhi, a very famous hospital is Gangaram, right? Everyone might have heard about it, even in Bangalore and stuff, because it is more aged asset. Dheere dheere brand banta hai. So this is a gestation business. So greenfield we do not like in new cities. So यहाँ पे अभी greenfield ऐसा दिख नहीं रहा. Short term में Gurgaon can turn around. There is no greenfield capex in India as of now. If it gets announced, then definitely stock will react to it, because your return ratios go for a toss. Then that is a risk. Mid-teens top line growth is possible. 12-13% growth. So these are growth is not an issue for hospitals. They can keep growing at 12-13% for a long period of time, right? Just because of the demand. Growth area is not an issue. But they cannot even grow at 25-30%, because that is also an issue कि इतना growth तो नहीं हो सकता. But secular growth of 12-13% in patient volumes and pricing seems to be very reasonable to assume. Medium term, if there is no greenfield capex which comes up in a city, their margins can inch up. Their payer mix is changing, and especially they can hit a ROE of 25-30%, which they're already doing 22% return on equity. Long term, it's a shallow cyclical business, because long term you are toast. You have to expand in new cities. So next 1-2-3 year type perspective, story seems to be solid, and let's see what ends up happening. Right.
On this, I went through the sector and I've looked at your webinar as well. It's a brilliant webinar. One of my concerns is that, at least in Bangalore, what I see is multinational hospitals, outside chains are coming and opening hospitals. Like, for example, Columbia Asia is one hospital chain in Bangalore, and I think they have 2 to 3 hospitals already, and it's a multinational hospital chain, and they have kind of created a brand name around themselves in terms of care, facility, everything around it, and slowly they have, within a matter of years, they've kind of taken the market of it. That's one. And second, what I see is every kind of every 2-3 kilometers outside, I see a big giant hospital in the city that's kind of working. So for example, for me, I have a hospital, I have at least 3 hospitals in just 3-kilometer radius. And if I expand that radius to 10-kilometer radius, I'll probably have at least like 6 to 8 hospitals that are all very good, not small hospitals. If I include small and medium scale hospitals, the number might be even more. So I feel that there's a lot of competition just for a limited amount of patients, because being a young economy, like most of us are in 20s to 30s age. So most of the like elective surgeries and kind of ailments and all of that happens to a aging population, which India doesn't have. And most of the hospitals are in the major cities like Bangalore, Delhi, Mumbai, Chennai, and there the market is kind of being saturated by multinationals coming in and taking the market.
Right, that's a very valid question. So just to bring you to this deck, so if I just look at the EBITDA margin, so rent ये लोग पता नहीं क्यों exclude करके बताते हैं. I hate the metric because this is just being clever. So yeah, EBITDA margin.
Adjusted EBITDA.
सबसे अच्छा तो WeWork का था.
Yeah.
Right. Rent को adjust करके you're telling about the EBITDA margin.
Yeah.
Right.
Even Renew and stuff, like if you look at US companies, they come up with all sorts of interesting adjusted EBITDA. Renew had a climate adjusted EBITDA.
Right. So their EBITDA margins in Bangalore are close to 31%. So actually in Bangalore, they're very focused on cardiac sciences. So even though it's a multi-speciality, but they're doing very complex or complicated treatments of cardiac sciences. And just in Bangalore itself, because it's a very like mature asset now, so doing brownfield wouldn't be a challenge. But as you rightly mentioned, supply side there could be issues with more hospitals come up. But what is also happening, Tar, in these cities is that a lot of people from tier 2 and tier 3 cities travel to tier 1 cities to get treated.
Yeah.
Right. So I think that is because tier 2, tier 3, you can't go and set up a 500-bed hospital.
Yeah.
And biggest problem in tier 2, tier 3 is that it's a chicken and egg situation. You need good quality surgeons. You need basically good quality doctors who are living in metros.
Yeah.
They're not living in tier 2, tier 3. Yeah. So that thing also ends up becoming over there. But I think just looking at the size of the opportunity, private hospitals, the listed ones, just have 1% bed share as compared to the entire industry.
Okay.
But yeah, that's a risk that can remain in the long term. Right.
Yeah, I just have one thing to add. Columbia Asia got acquired by Manipal Hospitals. So it's now a part of Manipal Hospitals Group. And just a small thing, I think I've seen this multiple times. Like say, for example, in Calcutta, a lot of times, because a lot of times I have to visit the hospital. A lot of times what happens is I see a lot of times there are people from Bangladesh in the hospital. With their passports, and a lot of these hospitals have dedicated international patients counters. So I've lived in Gurgaon for 4 years, seen this in Artemis, interacted with a few people I used to play football with, whose job was just to ensure if someone's coming from Afghanistan or Iran, they get all the paperwork done, organize their stay and everything. So, that's also a parallel thing that I've seen. And a lot of times they've cited reasons that there could be an issue that surgery is not available in their country, or B, it's under some program for which there's a wait list, which is like 2 years out. So for them, they can, even with the traveling cost, even let's say they're coming from a country which, let's say, has a lower income bracket, for them, the cost of doing that surgery in India still is much cheaper than, let's say, if they were doing it there. So sounds quite counterintuitive, but that's what I have. Ishmohit, any metric that you've seen in these hospitals, let's say for Narayana, do they disclose how much revenues come from their international patients by any chance, or any of these hospitals?
Yeah, there is this metric by the name of payer mix, that who is paying for the treatment. So generally there are insurance companies, then there is scheme-based business, then there are like India mein abhi bhi people are paying like out of pocket cash. 66% of treatment happens out of pocket cash. And then finally we have the international business. So international business, so for a lot of hospitals, it hasn't come back to pre-COVID level as of now. But sorry, just before we go to the next presentation from Tar. So one of the risks that remains is that, which I don't like personally, is that all these hospital managements are coming in the con calls. Apart from Narayana, this guy sounds literally depressed, that he's depressed in the con call. He doesn't want to talk to analysts. That if you look at the other managements, I don't want to name them, they're just thumping their chest on the margins, about the margins. Regulator can any day come and just strike them down. That's a black swan risk with the sector. That is there.
Yeah. Right. And one of the major things for this sector is that it's directly linked to health insurance. So in the US, if you look at the history of hospitals and how they kind of became this giant like profit machine, was mostly because after the health insurance kind of took over. Because then they were not dealing directly with the customer, they were dealing with some other third party, and they could charge whatever they want. And then suddenly the entire nation went through a lot of consolidation, and then they became basically masters of healthcare. And this 4 or 5 hospitals chains are basically controlling everything in US. So if healthcare kind of picks up, that can be another kind of a metric. If number of people sign up for health insurance, that can be one of the tailwinds for them.
Right. So now you can present.
Okay, so the next company, I'll present 2 companies together. One is Borosil Renewables and other one is IEX. Both are energy related, so I'll combine the 2. I'll kind of present both. So first we'll get started with Borosil Renewable. So at a very high level, there was a 5% quarter-over-quarter increase in top line and a 20% year-over increase. So if you compare this quarter versus December 2020, there was a 20% increase in the sales. Profits, there was even a very high increase in profits, so 30% quarter-over-quarter and 35% year-over-year. And margins became pretty extraordinary at 41%. I don't think these margins are sustainable, and I'll kind of talk about them in the next slide. But for the last 3 to 4 quarters, they're doing above 35% kind of margins. So let's look at sales first. So if you look at quarterly sales, from March 2019, you will see there's a dip, COVID-related dip. I will look at the sector or this company from September 2020, because that's when their kind of tailwinds kind of started for them with regards to their demand, their regulatory customs duty and whatnot. And this March 2021 quarter was extraordinary because solar glass prices throughout the world kind of exploded, out of which after that they have kind of stabilized more or less. And I don't see it going. I see glass prices going a little bit down rather than going up. There are more chances of it going down. So exponential increase was driven by higher demand, favorable pricing, and favorable regulation. So the reason why they were able to do kind of 41% operating margins this quarter is because they have a contract of first soda ash supply. And that contract expires in December. It expired in December, but they were able to kind of negotiate and extend it for 3 months more at a little bit higher pricing. So because the solar glass prices kind of shot up, soda ash prices also shot up, but they were not impacted because they were on a contract. So they were kind of able to kind of realize higher on the sales side, as well as kind of pay lower on the cost side. So, and if you look back from 2010 onwards, the trajectory of the sales have been upwards. And I do think this kind of sales will sustain and even grow forward, mostly because they're A, kind of increasing their capacity, and B, there's no shortage of demand. They are at present producing maybe less than 10% of the domestic demand. And if you combine like export demand as well, they basically have no shortage of places to sell this to. So if you look at the operating margin trend, March 2021 went to 53%, came down to 34 in September 21, and then again 41. I do think this is not sustainable at all. I think somewhere around 30% range can be doable for them. And as they kind of expand and bring more capacities online, there will be a high degree of operating leverage play out, which will kind of make the margin sustainable at 30%. Now, yearly profit margins, if you look at, this was a gruesome business until 2019-14, when they were kind of merged with the same company. When they demerged, favorable policies played out. You had basic customs duty from Malaysia, Vietnam, and China all put in place. So people, other countries couldn't dump solar glass in India. And the demand in India also shot through because of government policies. So their kind of margin profile also took over. In the short term, they have SG3 furnace. So they have 5 furnaces planned, out of which 2 are there today. They call it SG1, SG2. SG3 is the name of the another furnace that's coming online, and that will come through in second quarter of financial year 23. Now, customs duty is getting implemented in India from April 2022. So another month or so. And once you have domestic manufacturing of modules and wafers, your import of modules and wafers will go down, which is another tailwind for them, because when a module gets imported from China, it has glass pre-installed in it. But once you're making in India, you will obviously source the glass or have a preference to source the glass locally rather than kind of get the glass from China or someplace else. Mostly because most of these factories are next to each other, combined in Gujarat area, so you will kind of just source it from the next door neighbor. And when SG3 comes online, their capacity will go to around 1,000 tons per day. Right now they do about 500 tons per day. In the medium term, which is SG4, medium term is just 1 year. So to 2024 is when SG4 comes in, and that will take the capacities to 2,000 tons per day. There's a lot of growth in Indian manufacturers of modules. There's like a floodgates open. Everybody wants to make modules and wafers, which I believe is a gruesome business. So for them, it kind of plays out very well because they don't have any problem to sell their product. In the long term, SG5 comes online, which will take the capacities even further to 3,000 to 4,000 tons per day. And when SG5 comes online, they will be supplying at least 12.5 gigawatt worth of solar glass every year. And this industry is measured in gigawatts. So to give you an example or just for scale, India's after Reliance's and everybody's capacity comes online, in the next 3 years, India's solar module and wafer capacity will be 50 gigawatts. So Borosil Renewables will be supplying 12.5 gigawatts worth of solar glass. So if you're making 50 gigawatts worth of modules, you need 50 gigawatts worth of glass as well. But they don't want to scale up further. They want to scale up only till 12.5 gigawatts, mostly because they are very conservative. They don't want to take too much risk. They say if we kind of become more aggressive and suddenly the demand goes out, they will lose a lot of money. So they don't want to do that. So by FY24-25, they have given guidance or told and have plans to do till SG5. After that, they will kind of stop and we'll see what happens. And one other kind of scenario that's playing out in the business is when they were planning to kind of dilute equity for SG5 funding. They have raised debt and kind of done QIP till SG4. But they're making so much free cash flow today that the SG5 funding will take care of itself from the free cash flow. They don't want to dilute equity or raise any more further debt on it. So that was Borosil. Do you want me to pause here for questions, or do you want me to cover IEX as well and then we do questions together?
Anything that is like comfortable for you.
Yeah, I can do both. So we can do questions here.
Right. Saket and Sahil.
Yeah, just one question, Tariq. If I understand correctly, the Borosil Renewable is a price taker. I've listened to some of the con calls, and like I think the price primarily depends on like the landing price of glass from China and other geographies, if I understand correctly.
Yeah.
Please do correct. Yeah.
No, that's correct.
So what I'm trying to understand is, like, is this something that investors should track, or like, in your opinion, that's not worth tracking, or like, how do we think about that? And also, like, should we then also track supply and demand in China and the rest of the world so that we can track this, the movement of price and how it might evolve?
Yes, so very good question. So this is like exactly like Deepak Nitrite business, where you can't put money in and then forget about it. You have to track solar glass prices, but in terms of business wise, it's a little bit better than chemical business because the demand side is extraordinarily high. The whole world is kind of moving towards solar, and you have geographies like Latin America, US, Europe. Europe, in fact, is shutting down their nuclear power plants for some reason and doing solar. So all of that combined is kind of playing out well for them. So demand side is taken care of. In terms of price taking, that's a very good point. If the basic custom duty, which expires for them, I think August this year, if that is not renewed, from there's an import duty on solar glass from China. If that doesn't get renewed, then they will suffer, and their margins will collapse. So that will lead to the re-rating of all the from I think $600-700, the price should also collapse from there. But the solar glass prices are the most stable in the entire supply chain of solar, and the reason behind it is because solar as a product of the solar panel, if you look at it, if solar panel costs $100 to manufacture, solar glass is like $8 to $10. So nobody kind of goes there to kind of and solar glass doesn't have a lot of technology. Anybody can make it. The only technology is limited to your ability to kind of make it thinner glass, which is where the world is moving. So you are moving towards 2 millimeter thick glass, thin glass, and as long as you are able to make that, you're good. In the solar module, most of the cost is in wafer, and the entire module cost with assembling it together. That comprises of about, let's say, 75% of the cost of the module. Rest everything is logistics. So most of the industry, that's why you see Reliance and everybody else kind of moving towards wafer. And wafer, you have technology as well. You can always increase the throughput of the wafer. Right now, it's at the maximum 19 to 20% of the sunlight in the world that falls on a wafer. The best performing solar modules and wafers capture only 25% of the solar radiation, 20 to 25%. As long as you can apply technology and increase it, you will automatically gain market share. So that's where the Chinese players like Longi and stuff, they focus there. Most players, they are not bothered about solar glass, and even the Chinese giants that are the biggest in the world in solar glass have moved towards modules and wafers now, because they realize that the price for solar glass today will not go from 100 to, let's say, 200, 300, $500. That from 100 it may go, because of demand supply, it may go to 120 and come down to 90, but it will stay within that range. For a solar wafer and module, if you can do technological advancements, you can certainly charge twice, thrice, whatever you want, because suddenly the world will kind of start using your technology rather than the previous one. So that's the whole scenario, and that's the reason why most capacities and most players don't go towards solar glass, because at the end of the day, this is basic like a pure commodity business. And once the demand kind of sustains itself after 10, 12 years, the price multiple and terminal value for this is very, very low.
Thanks. Yeah.
Saket, do you have any questions, Saket?
None.
Great. So I think Tar, we can move ahead with your presentation.
Okay, cool. The second company that I'm presenting today is Indian Energy Exchange, and we'll talk about a very high level sales, profit, and margins. So you had a 7.2% quarter-over-quarter increase in top line and 38% increase year-over-year. Profits wise, again, similar momentum. You have 4.2% increase and 41% increase year-over-year. Margins actually expanded from 84% to 86, versus if you look at even the year-over-year from it as 84 versus 82. Now, if you look at the quarterly sales, the top line of the company doubles every 10 quarters. And the reason behind this is because they keep on expanding from one type of contract to other ones. So if you go back 10 quarters back, their day ahead market, which is when you kind of book, you trade the contract and book electricity on the exchange today, and tomorrow you will get the electricity. That was 95% of the overall pie. That has reduced down today to 60%. Everything else, they have introduced new form of businesses. So you have green day ahead market, which is the green energy. The next day you have real time market, which is within the hour you can get electricity. You have renewable energy certificates, you have energy certificates, and they keep on coming up with new ways to kind of come up with new avenues of revenue. So they are introducing derivatives in partnership with MSCI. Then they're doing a lot other things as well in terms of moving the exchange capacity from the PPA. So what used to be, I think, 2 to 3% in 2018 in terms of the overall how much energy of India gets traded on the exchange, it was around 2 to 3%. Now it's around 6.6%. And I do believe that will kind of move to 25% by in the next 3-4 years, and by the end of the decade that might be higher than 40-50%, mostly because all the PPAs, government has already said that you are allowed to, if the PPAs has like 5-6 years left, the discoms can get out of it, and the power producers can get out of it, and the government is regulatory like pushing towards exchange and kind of making electricity prices kind of uniform across the country. 10-year sales CAGR is 24%. And in the decade ahead, I think that CAGR can even beat the 24% CAGR, mostly because so many things are happening in this space in terms of the regulatory side as well as the platform side. In margins wise, it's very, very highly stable margins because you don't need any like variable costs to kind of trade higher. If the volumes increase, you make more money. Your fixed costs are always there. I do believe there's a limited room for it to grow. 84% will not become suddenly 99% because there's only so much you can kind of make profit on. Your fixed costs will always be there. However, if your volumes increase and your a higher margin business, which is like renewable energy certificates, is the almost like 100% margin business. So if that kind of takes over, your margins may even touch 90 in some cases. And another optionality is IGX, which is they have started kind of, so they have a lot of cash on their balance sheet. One of the main concerns of this company is how they are going to reuse that cash. So what is their ability to kind of create or scale up businesses. So IGX is an answer to that to some extent, where they are trying to use that cash to build IGX into as big a scale as IEX. Even there, you don't need a lot of cash. So that's why you see them kind of giving out 60-70% of their profits in dividends. And I do believe that dividends may go up. Within the short term, you have triggers for growth in REs, renewable energy certificates, energy saving certificates, which are both, they were on stop for almost 1.5 years. Now all the regulatory issues and court issues around there are resolved. So I do feel that that kind of is a sustainable and a good area for it to kind of make money. If you look at a company called Select Energy Systems, most of their revenue this quarter came from trading renewable energy certificates on IEX. So most of that is happening through, and other corporates are also kind of trying to source green energy from the exchange itself. So that's another area for them to kind of grow in the short term. Medium term, you have market-based economic dispatch, which is basically states that all the power, all the demand for exchange contracts will come to one exchange, and that will kind of get all the market demand will come. That will help in the price discovery, and that price discovery at that price, basically your contract will get sold for the electricity. So that will get implemented, but there's a angle of regulatory in there. If there are issues in implementing that, or the policy kind of changes suddenly, then that's an issue in the medium term. To get ahead, to get around that, they have also kind of announced some sort of an MBED policy around in their purview as well, where they are trying to do it in a privatized manner rather than a government oriented way. But that's a very gray area right now, so you don't know if that's going to pan out or not. long term is the same simple story, that the share of electricity traded on an exchange will kind of grow compared to PPAs in India, and the from 6% today, 6 to 7% today, that will become 40% of the overall pie. So that's the triggers here. The key risk I'll point out is that all of this is dependent on regulatory. So suddenly, if government of India comes and says that electricity cannot be monopolized in India, exchanges will have a limit. Let's say SEBI has a limit of how much a broker can trade, or Zerodha can have open limits on a FNO contract. So if a bank Nifty, for example, somebody wants to try opening futures and options contract on a day when there's high volatility, your range of bank Nifty kind of reduces to a few percentage points, 100 points up, 100 points down. And if you try to do it far out of the money option contracts, you won't be able to do it because there's a limit on the broker on how many positions can be opened with the exchange at a per broker level. Similar kind of things can play out in the energy market as well. So that's a regulatory overhang at this, and then the valuations are quite steep. So both are, I would say, both are pretty like high risk areas.
Right. Sahil and Saket, any questions?
I have a question, Tariq. You did mention about RECs getting traded. Recently, I had heard there was this company called Eki Energy. They were also talking about these REC certificates. Could you take us through what exactly is this, or is Eki something? Are they doing something which is similar, or will, let's say, IEX and Eki work together?
Sure. What EKI does is very different. So they do carbon credits, and carbon credits are nothing but, let's say, if you kind of built a mangrove plantation somewhere, you can get that plantation certified that because of this plantation, I was able to take out, let's say, 1,000 tons of carbon dioxide from the atmosphere. That entire process kind of involves some sort of paperwork and kind of consultancy work. So EKI helps you get that mangrove plantation certified into carbon credits. And the way they work is that they partner with the guys who own mangrove plantation, and they say, because you did this, we will do all the paperwork, and we'll take 50% of the carbon credits plus some consultancy fee that you pay us upfront, and the rest 50% belongs to you. Because carbon credit prices, because there was the recent COP26 that happened, because COP26 had a change in policy of how carbon credits are priced, they became free market rather than just at a regulatory driven kind of a stagnant price. So that kind of market exploded. The carbon credits prices went through the roof, almost like 4-5x. And because these guys were sitting on a lot of carbon credits that of the previous projects that they had done, they were able to sell it at a very, very high cost. And their acquisition cost is basically zero because they are doing just paperwork and consultancy work. So that's why EKI had a huge boom in their top lines as well as bottom lines. The problem with that is when the carbon credits markets flatten, you will see the similar kind of a fall in profits and margins. So carbon credits is as commoditized as they can get. Renewable energy certificates, on the other hand, are similar to what, for example, if you're creating renewable energy, and let's say you are able to kind of, for example, I'll give the example of Tesla. So when Tesla kind of gives every electric car that Tesla rolls out of its production line, it gets a renewable energy certificate from the government saying that you are responsible for helping proceed the cause of carbon neutrality and whatnot. So we give you the certificate because of it. And the worldwide over, you kind of get that if you're doing in the carbon or climate climate accretive kind of model. So if you're creating like the solar modules, if you're creating solar electricity, you get some sort of a renewable energy credit. So that credits are traded on the exchange. So IEX does regulatory renewable energy credits, whereas EKI does carbon credits. The only difference is carbon credits are done on a naturally way. So mangrove forest, planting trees and all of that. Renewable energy credits are done when you do anything which is not natural way. You create products, or you create batteries, or you create electric cars and all of that.
Thanks.
Great. Sahil, you have any question?
No question.
Right. I think thank you so much, Tar, for the presentation. So now I think we can switch to Sahil.
So the next two companies I'll talk about are Neuland Labs and Kilpest. Let's discuss Neuland Labs first. They are an API maker. If we look at the headline metrics, this quarter has not been that great for them. We can see that their EBITDA margins have dropped by 2.4 percentage points. And if you listen to the con calls, the reasons they pointed out are increase in raw material prices, logistical issues, higher operating deleverage in Unit 3. These are the main things they pointed out. If you look at the revenue, it was roughly flat overall, but the prime segment, which is sort of their most commoditized, high volume, low value APIs, that has degrown by like 20% versus the last few quarters run rate. What they have mentioned is that they faced challenges in inventory stocking, challenges in customer offtake. What they're essentially saying is that basically the demand just vanished sort of into thin air. And even they were a little clueless about what has happened here. Is it the case that the customers have lost market share? That's also possible. So that's what's happening on the prime revenue segment. CMS commercial. So CMS part of Neuland is where they do custom manufacturing, custom synthesis. And the fascinating thing is that the commercial part of CMS 9-month has also been sort of flat year on year. The 9-month FY22 versus 9-month FY21. So that was interesting because generally CMS has been having a very strong uptrend. The comments that they've given is that one CMS molecule actually went off patent for them. And that has been like the primary reason that CMS revenues haven't grown. Like basically when these molecules go off patent, they become genericized and the value of the formulation as well as the API fall by like a very large number, 70%, 80%. So yeah, that's that. On one sort of a small positive on the short term, last few quarters, they were not able to file any DMFs. So in this quarter, they have filed 3 new DMFs. So potentially it could be good in the next upcoming few years. They're not going to do commercial supplies here before I think FY24 or 25. This is anyway not a near-term trigger. These are the names: ariprazole, vilanterol, and tafamidis meglumine. They have decently large market sizes. What they mentioned is I think $20 million for each of them individually, the API market size. So market size is decent enough for Neuland size. So yeah, I mean, in the short term, what we can see is there were margin pressures and there were definitely revenue pressures. I would say overall, the business performance is definitely underwhelming in the short term. It's not catastrophic, I would say. And especially small B2B players face a lot of these problems. And another interesting thing I saw, if you kind of zoom out and look at, most API players actually have faced challenges, especially with revenue growth. And Laurus is the other example that I think Tariq covered. There are many others. Solara revenues fell by I think 75%. And yeah, there are many API players which have faced problems. So I think all API investors have to be slightly like, they have to take that decision on their own, whether they want to be patient or whether they want to sort of get out of it. I am being patient and sort of watching this carefully and like figuring out what's going on. Like I'll basically monitor each quarter like a hawk to see what's happening. So let's look at the long term and what we learned. So again, Saharsh Davuluri, who's one of the promoters and I think CEO COO, I forgot his title. But basically, what he says is that in the next sort of 24 months, we could have a couple of CMS molecules being commercialized, and these could potentially be blockbuster. That's the thing that they're saying. So promise is still there. What has been there. Also, what they have mentioned is, so of course CMS, it takes a lot of time and effort to commercialize it. It's if you have seen most of these videos on APIs and that value space, you know that commercializing any of these APIs takes like 8-10 years sometimes, like the end-to-end process from discovery to final launch. So yeah, that's that. Also, the other thing, like I said in the previous slide, pretty good large new opportunities, the DMFs that they find. So decent amount of promise, but people, thanks to the value picker community, have pointed out some pretty interesting antithesis pointers, uh, especially with respect to the long term. For example, if we see peptides is one area Neuland has been developing for like 10 years. I think they started from 2010. It's been 12 years now that they've been developing peptides. So in 2020 con call, they had said that we will file some of these DMFs in the next couple of years. Couple of years will be over soon. August 4, 2020. It's only like 6 months away. That couple of years will pass by. Linaclotide, liraglutide, and semaglutide. But now if we see August 3, 2021, 1 year later, now they're saying it will only be by the end of FY24 and FY23, and that would be like, March 2024. So definitely they're facing challenges. And in the meanwhile, what we see is that for these same molecules, others are filing their DMFs. For example, Dr. Reddy's has filed DMF. And we can see this for many other peptide players that they are able to file. So these challenges are specific to Neuland, that they are unable to develop these DMFs. So I would say even the long term is not exactly without cloud or without doubt. And I think all of that is reflecting in the price and the valuations. So yeah, that's how it is for Neuland. We can do any questions for Neuland if there are any.
One of the things that I would want to ask is, how do you perceive the management credibility? Because when I kind of was researching on it, my sense was that they always tend to kind of overpromise and underdeliver. And even with their, like, for example, that they mentioned, and one of the points you mentioned, the reason for underperformance this quarter was that one of the molecules went off patent. Now, something going off patent is not something you discover in a quarter. You know when the molecule is going to get off patent. So they could have guided it, let's say, 3 quarters back or even 2 quarters back, that, hey, this is something that's going to happen. So in terms of that, where do you see and how do you kind of rank their management?
Yeah, good question. I think there are it's a mixed bag. I would say if we look at their annual reports, I found them to be one of the most honest managements in admitting what has gone wrong, clearly pointing out what mistakes they have made and the corrective steps that they're taking. So I think I do like the fact that they always admit to what has gone wrong. But you're absolutely right. So I think full marks for honesty. But when it comes to capability, probably they don't get full marks because they are completely unable to see the future as they say it, right? But on that front, I would say one can make similar comments about Laurus as well. This channel destocking, again, Chava sir had said earlier that it was not channel stocking at that point. And now when the growth didn't happen, he said it's channel destocking. So I think like some of these challenges we see actually in many of these DMF, generic API players. And one interesting thing I figured out talking to some people in this value chain is that it's actually the case that these API players are completely clueless. So one of the questions they asked on Value Picker is, how is it possible that you were saying that one of the APIs is performing well for me in, let's say, Q2 con call, and then in Q3 result you're not doing that well for that same API. Like, how is that possible in a matter of couple of months? My understanding is that actually this space is very dynamic. And like it's very hard for managements to really predict what's going on. So I would say management, good marks for honesty, not so good marks for sort of capability of admitting. One more thing I would point out is generally the guidances that they give, like you're absolutely right. they are slightly like, I would say, over bullish. For example, they always guide for 20% EBITDA margin, which hasn't ever happened. I don't think it has happened even once. But yeah, it's up to the sort of investors to like probably quiz them better and figure out like what's going on.
Yeah.
A link to that question, Sahil. So I had just had this question. So I was listening to Navin FluorineQ's con call. So they supply intermediates to all these generic players. And they mentioned that we are intentionally reducing this business because sometimes we receive the purchase orders and even we manufacture the goods. But when it's a time to do the basically take the delivery of the goods, API player is experiencing some kind of destocking, stocking, or some kind of that. So, given the variance of outcome, is this sector apart from 4 or 5 players even worth looking at? Because then you can never ever sort of allocate 8, 10, 12% of your capital in such ideas.
Right. And just to sort of link back, you said in Deepak Nitrite's case, one of the segments always saves them. I would say in Neuland's case and in most of the generic APIs case, because these are such complex businesses, one of the segments always disappoints and like the company doesn't do well. And you're absolutely right. Except for a few select API players, of course, DVs comes to mind. Most haven't been able to sort of give sustainable kind of performance. Uh, I think there might have been some amount of overestimation of the industry structure. I think the industry is not that great, not yet anyway. It is also possible that China plus one, like we have to figure out. This is something I think Aditya Khemka sir said in one of the webinars. We think of pharma as one sector, but it's really 4,000 sectors, so 4,000 different molecules. You have to figure out for every molecule and thus for every company to what extent these tailwinds are actually there. We can't just generalize that every API player has China plus one tailwinds and so they are always going to grow.
Right. I think great. So Saket, do you have any questions? So no questions from my side anymore. I just wanted to.
I think I think Sahil mentioned right. This quarter, Divis actually hit things out of the park. I mean, obviously including Molnupiravir, which was a one-off COVID thing, but yeah, I mean, Neuland, Sahil, I've tracked this stock for quite some time. And, every time, just like Tariq says, right, they always overpromise and underdeliver. Whenever you see they're overpromising, there is some visibility on revenue, suddenly the stock runs up and then suddenly it crashes again. Like if you just see the 5-year chart, it's probably like this. So I think for someone who's really looking at this company, you really need to know the entire moving picture. And, despite knowing everything, there could be a high possibility that you know nothing. But that also is how complex this whole structure and this whole industry is, as Ishmohit pointed out. So yeah, and also you pointed out. So yeah, that's all I have to say.
Yeah. I would just add one quick thing, which is even if we look at the last 3 years, I would say they have done decently well. Like their sales have compounded 20%. So like just to cut them a little bit slack, all that they ever say is over a rolling 5-year period, we will manage to grow between 15 to 20%. That's all that they've ever said. And now investors expect year-on-year growth. That's on us, I think, not on them. And I think Kumar Siddharth, I think his name is, he made a wonderful point on Twitter, which is for such kind of businesses, we need a wonderful margin of safety and sort of like buy them when the pessimism is at the highest, like so that we have that margin of safety.
I think also, please.
No, go ahead, Ishmael.
I think it's not even yearly. It's better to look at such businesses on a 2 to 3 year rolling basis.
Yeah.
Right. Because lumpiness is there. It could be that it's not everyone's cup of tea, these type of businesses. So it's always your own call, and it's your own, at the end, it's your own portfolio allocation call as well. Whether someone wants to allocate a large chunk or whether someone wants to allocate basically a small chunk. Right.
Also, great point, Sahil, on the annual report. I think they were probably the only company that had first given that comparison of what this China versus India cost bridge looks like and what is it that makes, let's say, Chinese APIs cheaper than Indian APIs. So yeah, I think multiple times, if someone really wants to understand the whole space, not just Neuland, I think their annual report can be a great primer to read.
Yeah, absolutely. So let's go on to the
Tariq,
next
you were
one.
saying something.
Oh,
No,
sorry.
I was just saying that that like if somebody has like 2-3 year time horizon to invest, it's better not to go after this industry. Just stick with like a music industry or like a platform kind of a business. There you know that there's no challenges in demand and supply, and margins won't fluctuate.
I think
Yeah.
just to add to your point as well, Tar, I think it's just not this industry, it's because of COVID as well. A lot of growth which was supposed to happen over 3 years in businesses like Web of Global, or if
Right.
I talk about businesses like C, which is listed outside as well. So a lot of that growth got compressed to 1 year. Then from off that base, we are seeing disappointments that are happening.
Yeah, just mean reversion.
Right.
Yeah.
Right. Right.
It's not only this sector, across the sectors.
Yeah, true. Yeah,
right.
that's true.
Right. So let's cover the second one or third one, which is Kilpest. This is a extremely small company, and I thought it would be interesting to cover this because, in addition to presenting, I would also want to ask question about it, not just answer questions. So this company is interesting because I haven't seen company of this size such high up the value chain. Essentially, what they do is they make testing kits for diagnostic companies. So anytime you want to test whether you have a particular disease, or not just disease, but other markers, for example, like for example, in cancer and oncology, you might want to test, is it that kind of cancer, this kind of cancer? All those kind of tests, genomic tests, as well as blood tests, all those tests are tests for which Kilpest, or more specifically their subsidiary 3B Black Bio, makes testing kits. This is extremely high margin business. I was just looking at it because I'm unable to remember, but let me just quickly look at it. If I remember correctly, it's about 60-70% margin or something like that. So yeah, pretty high margin business. The
Around
interesting
50-60% margin. Yeah.
Yeah. And the very interesting thing, if you look at the quarterly sort of results here, is that pre-COVID they had similar margins. During COVID they had similar margins, and now after COVID, so to speak, they still have similar margins. And also the the rate of the COVID kit has actually gone from 700 rupees for an RT-PCR kit in the beginning to 50 rupees now. It has fallen by a factor of like more than 10, and still they have the same margin or similar kind of margins. I think that's very interesting to me. What that also shows is that they're completely able to pass through any fluctuations in basically like whatever raw material they are using. So let's look at a few of the metrics. The EPS growth, uh, non-COVID diagnostic revenue growth. So basically, this business right now has like sort of three parts. One is the agrochemical part, which is sort of a more gruesome kind of business. And then there's the diagnostic kits. In diagnostic kits, you can again think in terms of the COVID part and the non-COVID part. So most long-term investors here are only tracking the non-COVID part. That's what we are most excited by, because COVID is a one-off. We don't want to give a multiple to that business. So what we see is this business now is growing pretty fast, and this was growing pretty fast pre-COVID as well. The non-COVID sales, if you look at a 2-year CAGR, that's around 38%. So that also shows that they are able to cross-sell very successfully to whatever diagnostic centers they had penetrated through their COVID kits. We have done a bunch of scuttlebutt as well, talked to microbiologists, and people generally say that they have pretty good quality kits, somewhere on par with Thermo Fisher. I'm seeing that at the risk of angering many people. Uh, of course, I don't mean to say that it's exactly the same, but like sort of, if you care about price, you'd probably buy 3B Black Bio. If you don't care about price, you'll probably buy Thermo Fisher. But it's pretty good quality. So another interesting thing in the short term is there's a scheme of amalgamation where they are going to sort of make 3B Black Bio the listed company, and basically Kilpest will sort of merge into 3B Black Bio. And they want to do this to bring out their brand, the fact that they're a biotech company. They're not Kilpest, which was originally a agrochemical company. They have received a bunch of approvals already. They're waiting for one last approval from NCLT. And conservatively, they expect to sort of do this amalgamation in a year or so, roughly. Another interesting thing is because of COVID, so this is roughly a 300 crore market cap company. They have around 120 crores of cash right now. So that's one big question mark. It's opportunity as well as a potential weakness. We have to see how they deploy that cash. So what promoters have done until now, let me go to the next slide. Is that they have actually acquired one of their European distributors, HS Biolabs, and they're re-establishing it as True PCR Europe. The reason they needed to do this is they realized that this is a very small industry overall, so they have to grow the exports. That's the only way that they can scale or scale at the level that they want to scale. So for doing that, what they also realized is some of those customers are not very trusting of an Indian kit maker. So that's why they wanted to create a subsidiary right there in UK. And this True PCR Europe would do R&D as well as sort of distribution of all these products. So we can see that, they want to do like R&D and export sales. Also, like we can see actually that, they're walking the talk as well. If you look at the value of exports, they only did like 1 crore of exports in FY20. They doubled it in FY21, then sort of did roughly the same volume in half year FY22, which is like the June and September quarter. And in the latest quarter, they have done 1.8 crore. So it's pretty, they are able to scale it up. So we can see them actually walking the talk on that. And, this is what proves the mettle of a company, the fact that they're an R&D company. They're actually able to now create the rapid tests, the rapid antigen tests. And that is what, COVID testing and most of testing generally shifts to. If you talk to a microbiologist, in any disease generally, we start off with RT-PCR tests and we move to rapid antigen tests. So that is the progression that Kilpest has also been able to make. So yeah, that's all I have. Yeah.
Right. Any question, guys?
So in this, after COVID, like you said, they do other testing kits. So what are the examples of other testing kits?
Couple of them actually, they have a lot of kits on basically non-communicable diseases, things like oncology. That's what I mentioned earlier. Like basically cancer patients need to do a bunch of tests to figure out like what kind of cancer do they have and what kind of treatment they need to take. So diagnostic kit, molecular diagnostic kits. That's one thing. The other thing is, they're also making this thing called NGS, next generation sequencing. And again, this is extremely niche stuff, but basically, if I remember correctly, what happens in NGS is your normal tests are run at a lower frequency, or sort of you have to test it one assay at a time. You have to test it one sample at a time. NGS technology actually allows you to test millions of samples at a time. You can sort of mix all of them together and test them together. If not million, thousand, I forgot the exact scaling factor, but it makes it sort of many orders of magnitude more efficient. So they're basically developing all of those. Yeah. But sorry, I can't answer it more completely. I don't have a good memory, but I did create a thread on this. So like, feel free to read up or just see the value picker thread. Or just see their investor presentation. They've actually talked about all the different types of tests.
Cool. I'll check it out.
Yeah.
Great. Saket, any questions?
Yeah, Sahil, I was just going through the numbers on Screener while you were presenting this. So March 21, obviously because of COVID, there was a big bump up. I could see steady state for the last 10 years, they've done 23 to 30 odd crores of sales annually. Suddenly in March 20, you see 230 crores. And right now, trailing 12 months is about 80 crores in sales. So going forward, with all this, or let's say if I remove the impact of COVID testing, right, whether that'll happen or not happen, what do you think would be a steady state number, specifically non-COVID, along with, let's say, all of this?
Yeah, actually, that's a great question. Actually, pre-COVID, they used to do roughly 20 odd crores. March 20 also is slightly misleading, actually. That also has some COVID tests in it. And also, like they developed their RT-PCR test extremely quickly, and like in a month or so, because they were already making RT-PCR tests for other diseases. That's why they were able to do it very fast. Um, but I think right now the run rate is March 20 they were doing 16 odd crores in the diagnostic kits. Uh, Now the run rate is around 30 odd crores. So actually, like you have to go to the segmental revenue, because their agrochemical also is a like one of the divisions, but we don't value that too highly. I place zero value to the agrochemical business. So if you look at the numbers, 11 crore in 2019, 16 in 2020, now 214 in 2021. Now their non-COVID revenue is at a run rate of 8 crore per quarter, so around 32 crores. So that's why the 38% CAGR, they've doubled in 2 years basically. And if you look at the pre-COVID, they were growing around 30-40%. So that's the thesis right now, that they should continue to grow 30-40% at a 30 crore run rate. But the thing to remember also is, again, this is a very tiny company, but they have extremely high margins. So on that 30 crore, they can easily make at least 12-14 crores of PAT. So yeah, profit wise, pretty significant.
Yeah. Got it. And this is more of a B2B kind of a business that they have, right?
Yeah, absolutely. And in fact, we have done a lot of scuttle, but basically they sell to most diagnostic chains unless they make their own kits. Basically, if someone makes their own kits, that's that. Otherwise, they sell to like most diagnostic chains. Yeah.
Great.
Yeah,
that's more or less what I had.
Cool.
Thank you so much for the presentation, Sahil. Saket, let's have you present. Any more questions before we move to Saket's thing? Tar, if you have any questions.
No, thanks from me.
Great, super.
Okay, so the third company that I have to present is Bajaj Finance and their Q3 results. So, one can go and read multiple NBFCs and their investor presentations. But I think the kind of granularity and let's say their details which Bajaj Finance puts, despite being a company this larger size, this is quite exciting, right? So this is something which they do in every quarter. So this quarter, they've guided that they're gonna continue to grow somewhere at a number of almost 25-27%. This is the assets under management that they have, which typically is, because it's a non-bank lender, one can assume that this is just the loan book growth that they are projecting annually year on year. They want to keep the profit growth also in the same corridor. Although, if you see the last 14 years CAGR of the company, their AUM growth has been almost 37%. And this is, I'm talking pre-COVID. And their PAT growth CAGR has been 50%, right? So it's like, they always under promise and over deliver. In fact, I'd also tweeted out recently, which apparently also went a little viral. There was a sell report by CLSA on Bajaj Finance, and in the disclaimers, they wrote that whenever someone has put a sell rating on the stock, they have gone wrong. There is a high chance that we will also go wrong, right? So having said that, while I was going through this company and actually trying to understand this a little deeper, I actually did a lot of scuttlebutt because I had to do justice to the analysis, right? Because this stock is fairly covered. It's also like one of the darling stocks. You open up any mutual fund, this will be in their top 10 holdings. So it makes sense to go a little deeper as to what really makes this company that unique. What is interesting now is a lot of people already know what these guys do. And if you see, let's say the price to book multiples at which it trades, and the growth that it has already shown, a lot of what they are talking about in terms of their guidance is priced in the stock, right? So you can't expect, let's say, for someone to look at Bajaj Finance and see this to be let's say, because last year anything that you've touched has almost gone up. In fact, even Bajaj Finance went through a similar trajectory. But I still feel if we are looking at India as a country where the share of formal credit is yet to come into the system, because a lot, while people like let's say the people that we interact with, or you and I have access to formal credit, a lot of people still rely on informal sources of credit to, let's say, do even their daily basic needs or even their aspirational needs. And what is very interesting about this company is, despite this breakneck speed of growth, they've always managed to keep their NPAs way below 1.5% mark. So that is quite exciting, which, by the way, up until now, I mean, what happens is whenever there is growth, people keep growing their book. And suddenly when the cycle turns, you start seeing a slew of NPAs come in. And then, you also have a issue in raising money, right? So in all these basic pointers, they've managed to weather that quite well, right? And Q3, again, these were the numbers that they disclosed. So they said that this was the highest ever growth in the amount of loans that they added in this quarter ever since the inception of the company. So I think they added close to 14,600 crores of loans in this quarter, and there was a 26% YOY growth on the AUM. Although he did mention, Rajiv Jain, who's the MD, that the PAT number is not comparable. Although this 85% growth number is not comparable because last year there was slowdown and they had provisioned for let's say parts of the book which had stress in it, but they maintain their long-term guidance of ensuring that they deliver the double-digit ROE numbers that they talked about, right? So if you look at the book size is almost 1,80,000 crores. And what is quite interesting about this whole book is, most of the people think of Bajaj Finance as a white goods financier, right? Which is the product that they pioneered, which is the zero cost EMI. But that book that comes under the consumer B2C business, that's almost 36,000 crores, right? It's roughly 20% of their book. What is quite interesting is their ability to cross-sell, not just other financial products. If you see, fee income is almost 52% of their PBT, but also the fact that how you can keep upgrading the customer to, let's say, a home loan, or let's say if he needs a personal loan, so on and so forth. And the fact that they are able to keep adding customers quarter on quarter. So that machine, I mean, in India, someone else is yet to see how, let's say, everyone aspires to be a Bajaj Finance. So if you see, a lot of NBFCs today are listed. A lot of times when you hear their con calls, a lot of times they just shy away and say that, Bajaj Finance is not our competition. They do a bunch of things. They do a lot of things and they are able to do everything right. But we just want to do 1, 2, and 3 and ensure that we can get it right. So that, to my mind, is quite exciting about this company. Although in this overall book, the auto finance business still continues to be in stress. This GNPA number has been coming down. In June, it was almost 19% GNPA, which means 1 out of 5 people who had an auto loan were not paying, which was quite alarming if you ask me. But they've managed to bring that number down, and hopefully they've guided that this will normalize going ahead in the year. As Sahil mentioned, Angel One was building a super app, and they are looking at ensuring multiple journeys are captured the right way. Even Bajaj Finance right now is in the process of a tech-led transformation, and this is the slide that they had put in their investor presentation, where, let's say, they want to address a lot of these layers in their super app, right from payments to ensuring you have other proprietary apps which retain people into the ecosystem. And they've talked about how they are going to do it, right? So this is the feature set that they talk about. At the same time, how are they going to enable these feature sets? So they also have hired almost, I think, 150 to 200 people for their tech team. And they are also hiring another 100 people for their payments platform. So even they are building this, and they just feel that this is the right way to look at the problem going ahead, because lending, as we see, is getting commoditized. So people no longer care whether your loan is at some point coming from an SBI or, let's say, a DCB bank. What is in front of you in your mobile screen is an app with great UI UX. And because you are spending multiple time on that app, it's only a matter of time. The app is then doubling up to ensure you get other services. So at some level, today when we see a slew of these fintech apps who are lending at some level, let's say they have great UI UX, getting customers, they all have their front end, which is quite exciting and quite great. But the back end at some level is getting service through a bank or NBFC. For Bajaj Finance, I feel the problem is opposite. So they have their back end underwriting standards, the TAT to ensure loans are disbursed at record speed, quite sorted. And this is not something which they've done today. They've been doing this for 14 years, right from a time when India didn't have the UPI stack, right from, let's say, the consent layer, or let's say this trinity of Aadhaar, Jandhan, and mobile. But I think it's for a company for this size to think of things in this direction also goes to show how important they feel this is to stay relevant, right? So, I mean, looking ahead, I feel at some level, as I mentioned, I mean, at 10 to 11 times price to book, people are factoring in what the growth the company has been able to deliver, and going ahead, whether they continue to deliver on that. So any, let's say, re-rating on the upside or on the downside will be on account of how efficiently they are able to do the tech-led transformation. And there is a concern with respect to doing this in-house or just acquiring a team. A lot of these great BNPL assets, if you see globally, whether it's Zip, Klarna, Afterpay, they've at some level blown up vividly, right? These could potentially be great assets for, let's say, someone like Bajaj Finance to just acquire the team, just to ensure that the tech is sorted at some level. So there's also this challenge of whether you want to do it in-house or do it through acquiring. And I think right now they've treaded on the path to do it in-house, but let's see how this evolves, right? So I think that's what I have on Bajaj Finance. Happy to take questions.
I just had a question here, Saket. Now, see, my question is, again, I'll try to reverse fill the valuations with the numbers and the narrative. So currently, HDFC Bank has a retail loan book of 4,80,000 crores types, right? And Bajaj book, like if we talk about Bajaj Finance, I think entire size is close to 2 lakh crores right now. So at a price to book multiple of 10 times, we are really actually factoring in that the historical growth rates will continue. But when do we actually say that the base size is too big and the historical AUM CAGR of 30-35% is no longer feasible or plausible? Because even in HDFC Bank, we have seen that at a given point of time, it was growing its book at 45-50% in the initial days. Then it fell to 35-30%, then eventually deaccelerated to 25-30%, then to 20%, and now to 14-15% because base is huge. So this such a huge base, like should it command such valuations? Because if an investor is actually betting today, so he's really betting on the tomorrow. So if tomorrow the AUM CAGR drops to 15, 17, 18%, so do you think it will be like feasible to make a decent CAGR from here for someone who's betting today?
No, I think that's a fair question. And I mean, at any point of time, these concerns have always been there with Bajaj Finance. At some level, they've just been like that outlier, just like, when you see retail and what Amazon keeps doing, every year, and with respect to, let's say, multiple categories, so on and so forth. I think with Bajaj Finance, what is really interesting is, at some level, they did pioneer the concept of cash flow based lending, right? Historically in India, every time a lender, had to lend, it was always an asset-backed lending or a secured form of lending. Bajaj Finance at some level ensured that they were able to capture on these alternative data sets. It could be, let's say, the mobile bill that you pay, or, because let's say you're a doctor, there is a chance that, you have a great income earning potential. And using those alternative data sets, they were able to, let's say, lend better and ensure that the NPAs were low. Now, whether growth slows down, yes, obviously at every market, right? So let's say in a particular geography, like say, for example, in East, now their core product still at heart remains white goods. That is like the hook through which the customers come into the Bajaj Finance ecosystem. Or let's say on the HNI side, it could be IPO financing. They run a decent amount of book on IPO financing. So let's say on the white goods front, there are alternative lenders who are trying different things. But let's say the sheer scale at which Bajaj Finance operates with respect to, let's say the people that they have on ground, their collection agencies, or the way they are able to service their loans better. I mean, as a challenger to that, as of now, we don't see a pan-India player per se, right? I mean, okay, in specific markets, you can see degrowth, but at some level, on a pan-India basis, they are able to still grow. Yes, whenever this number suddenly drops to, let's say, 20 or 25, I mean, I don't know the answer, right, at what AUM that happens. But whenever that happens, you will see valuations derate, and then you will see some mean reversion happen. So yes, at these levels, there is still a risk with respect to having a cap on your upside, right? So that, I mean, point well taken. I do see that as a case with respect to getting a derating on that. But until and unless you see that growth coming in, I think at some level, maybe it doesn't re-rate on the upside, but it sort of remains at that level. Which is why I said that any upside or downside for you to really make an investment case is how efficiently or how effectively they are able to, get on this journey of tech-led transformation. Because the other thing that has opened up is your digital channel of acquiring customers, right? So today, I mean, let's say if you're shopping on Amazon for a TV, there is a high chance that on checkout, you, let's say, finance it through a credit card or through Amazon Pay itself, right? So all apps are doubling up as LSPs, which is loan service providers. I mean, Zomato, I think in their last quarterly call, talked about the fact that they are now incorporating an NBFC, and they are saying, why let our partner do this when we can do it ourselves, because we own the customer. So quite exciting times with respect to how this space is evolving. So yeah, that I think is what I have. I mean, I don't know at what level that will happen, but it could happen. So that's a risk that we run with this thesis.
Right. Sahil and Tar, any questions?
Just one question, Saket. This super app or the tech-led transformation that they're doing, what is the objective of that transformation, or like what are they trying to achieve out of it? Because I heard this interesting thing somewhere that one of the differentiating factors of Bajaj Finance is that they're able to capture a lot of that value in the complete life of the customer. Like you rightly said, from a TV EMI to then eventually a home loan EMI, a vehicle EMI, and so forth. So they're potentially already doing a lot of that value capturing. So like, what is this tech-led transformation or this app bringing to the table? Like, what are they trying to achieve with this?
So they've talked about this through their presentations, both, let's say, on their on the backend side. So let's say if there's a collection agent who has to ensure that loan collections happen, or let's say on the merchant side, you ensure that you're able to get a visibility on what your customers are and whether you're able to collect money on time. So they are doing that through multiple partners, right? So let's say one is obviously the consumer, which is the core product. Then you have, let's say, other people in the ecosystem. So the merchant, their own team of agents who do the collection or service the loan. But on the consumer side, right? Right now, the value proposition, if you see for most of these apps, I mean, let's take the example of Paytm, right? So their core product is payments. You enter the app ecosystem, you use it for, I mean, you transact for payments, and then Paytm upsells you through, let's say, a pay later product or a loan, right? For Bajaj Finance, it's a little bit on the opposite side, right? So you already own the customer, right? And let's say today, if the customer has to get another financial product, or at some level, let's say, shop on Amazon, right? Now, obviously, that shopping is not something which I buy into a lot. But they are just getting all of that together in one place. So instead of you going and let's say taking an insurance from a third party, just get it done through the Bajaj Finance Super app, right? So I've used the app multiple times to test. So you also get co-branded credit cards with other banks. RBL obviously is their core product. Recently, RBI had come out, I think there were regulations that now NBFCs can also issue credit cards. So it'll be quite interesting how that pans out, right? Now, on the FinServ side, they've got the AMC license. So you will then see probably the Super app also starts distributing insurance, which is again coming back to Bajaj. Now, how this whole fee income movement will happen between finance and FinServ, it's still not clear. But as of now, I do feel that the core lending product still has a nice little runway for growth.
Thanks.
Nothing from me. This was pretty explanatory, and finance businesses I tend to stay away.
Great. I think that's it, Saket. So thank you so much for the presentation. Like, no more questions from my side. If Sahil has any, so he can ask.
No questions.
Great. So let's move to the final deck. So just before I move ahead, so actually all of us wanted to cover even more businesses, but because of time paucity, we couldn't. So if you want us to cover more businesses, do drop a hell yes in the comment section below. And if there are many comments, so then we'll consider doing a part 2 for the session. So just opening the presentation, right? So next, so is the presentation visible, guys?
Yeah, I can see it.
Yeah.
Great. So next business that we'll be looking at the result is Navin Fluorine. So again, just a disclaimer. So just before I go ahead as well, valuations today are high for the business, and if valuations are high, then you have to really deliver on your earnings growth. You cannot afford misses, right? So I tend to look at businesses where valuations are high, but earnings are like consistent type. So I generally do not invest over there because there is no fun in making 10-12% CAGR if the capital size is small. Like I don't have a I'm not getting 2-3 crores of 2-3 crores of dividends from my investments. It's a very small base of capital. So whenever so my framework is, if we are invested in a high PE stock, so the earnings growth have to be really exponential. And one thing is for sure, there is no margin of safety in the valuation. There is no margin of safety in the price. There is no margin of safety in whatever DCF you want to do. Only margin of safety is whether you are able to grow your earnings non-linearly or not. If you're not able to, then you get backed on the multiple. That is as simple as that, because see, PE ratio is actually sentiment to earnings ratio, and both of them move together, right? So both of them are proportional. If earnings do well, sentiment does well. If earnings do badly, sentiment also does bad. And so when both of them do bad together, then that is when you get the painful derating. And when both of them do well together, then that is when you get the joyful re-rating, in my opinion. And so coming to this business, now their year-on-year revenue change was close to 23%. But what was actually credible was that they ended up expanding their gross margins. So the gross margin expanded, when EBITDA margin expanded by 39 basis points. So in a quarter where all the chemical businesses or all the API businesses have been have been in the doghouse literally because of margin contraction all around. So maintaining margin itself was sort of something that was extremely interesting. Even we have seen some of the companies in the consumer sector where the margins have actually contracted because of raw material variation, and these margins were maintained on back of deferment of CRAM supply. So the highest margin business ka to supply nahi tha is quarter mein, right? And those suppliers have got basically bunched up in the next quarter. So next quarter, if they're able to maintain this, so we might see even further expansion from here. And secondly, so they reported a PBT growth of almost 27%, which I thought was extremely interesting. And just looking at the competitive landscape of the fluorine space, which we talked about in the Deepak Nitrite presentation as well. So Lakshmi Organics has acquired a plant in Italy. So they are importing an entire plant from Italy, that is of Miteni. Then Anupam Rasayan recently acquired Tanfac Industries. They acquired Tanfac because Tanfac produces PK, and they also produce hydrofluoric acid, which are the key raw materials for fluorine production. And then Deepak Nitrite is mentioning that we'll enter agro intermediates. Aztec Life Sciences is mentioning that we are entering agro intermediates. Now, in a nutshell, what is going to happen over here is that the competition, especially in the agro space, that is going to increase. So I also had this discussion with one of the industry veterans. So he's in the probably top line wise the largest agrochemical company in India. So he mentioned that some of the companies which are reporting like 4,000 crore run rate in CRAMS today, like the competition area in agrochemicals for last 5-6 years wasn't much. It was basically a lot of players just left the thing because players like Rallies, Dhanuka Agritech, these all concentrated in formulation business, and they also they never concentrated on the CRAMS business, especially in the agro part of the value chain. So for competition in the agro part of the value chain will go up. So this was one of the industry insights which I could get from the con call. And I went through the con call of all these companies, especially to get an idea on the fluorine space. So when we sort of entered Navin Fluorine, why didn't we get into SRF or Gujarat Fluorochemicals? SRF is actually epic in terms of capacity building and aggression wise, because they did the capex in a down cycle just to reap the rewards in an up cycle. So Navin, the primary reason was that in F3, F4 and F5, and there's also one more chemistry, they're the only Indian players that is in the trifluorochemistry and Western Hemisphere. So they're competing with companies in Western Hemisphere, and their biggest competitor is by the name of Doticon, which is a Swiss company which also trades at some 70 times multiple. Right. So in terms of fluorine space, I think it will eventually get commoditized. But you have to you have to understand that even in that commoditized space, which sub-segment is that niche or basically where you can get the margins. And that was part of the thesis of actually getting into Navin earlier as well. So now they're basically diversifying even away from agro into basically other applications of fluorine. So this was a post which I posted on Value Pickle. So I've been posting on Navin for a while now on Value Pickle. You can read all our threads. So this was one of the posts where actually I tried to figure out all the triggers that can come, because valuation is high. So you need 25-30% earnings growth for this valuation, even if it contracts like 30-40%, for you to make a compounding returns of 17-18 or 14-15% types. So when valuations are high, you need to look at what are the basically triggers. So there were 8 triggers, out of which one has already played out. So their capex is going live for 365 crores for high performance product plant. So they have done an exclusive 7-year tie-up with Honeywell. And in this tie-up, so it's a patented product. So over there, margins are like 27, 26, 28% types. Then one more capex is going live, 195 crores. Then there is one more capex that is going to go live in next 4 to 5 quarters. That is a 125 crores. So these 3 capexes will add somewhere close to 800 to 850 crores of sales. And then there are 20 to 25 molecules in pipeline in this basically in the chemical division, which are further opportunities that can go live. Then they've announced the debottlenecking of CGMP3, which is their CRAMS business. So with 70 crores of debottlenecking, they can generate sales of 200 crores. And apart from this, they're also setting up CGMP4 after this. So next year, we might also see announcements of CGMP4. And that will be a bit bigger in size. And they have approvals to set up till 6 CGMPs. Right. So something like once you get into that virtuous cycle, then you keep setting up more and more plants, like what PI did in last decade. Then one of the platforms, so this actually played out in this con call, that they actually announced the debottlenecking of CGMP3. Con call was happened a week ago. Then they're exploring more and more opportunities in 5G area, electric vehicle area. So they are setting up a dedicated R&D plant for this. And we might also see they announce a separate business unit for this. Right. So these are all the hints that I could grab from the con call, because whenever valuations are high, my tension also goes high, because with great valuation comes great responsibilities to see the earnings growth. If you're not able to envision that earnings growth, then you get a sequent. And I've been there, I've done that. Like we bought it at 160, 165 rupees, saw it till 330. Then I took the entire painful hit, because earnings growth went away for 2 years. Valuations were disproportionately high. So those experiences teach you where you went wrong. Then you do a post-mortem analysis. This is where I went wrong. So I have to be very, very certain. Now, if the earnings growth derails, then you already know what type of outcome is plausible in B2B businesses. So you have to be very, very careful when valuations are high. And this is first time after 5 years, actually company is going to raise some debt to do capex. So this was one of the most bullish signs, because I remember people used to call this company the SOIC management. Those are 18-19 mein. because stock didn't go anywhere between 2018 to 2019. When stock doesn't go anywhere, we have all kinds of narratives. So ये management है, ये तो लोग बेवकूफ है, इनको काम करना आता नहीं है. All kinds of management like narratives are there.
सारे downside trigger stock price गिरने पे आते हैं.
See, so I recently met Ashish sir as well. So he told me that someone presented Saregama at 300 rupees. Entire room was laughing on him. ये क्या present कर दिया? Right. So I think these narratives do play a role. This is where it is opportunity, and sometimes, like most of the time, social proof is right. So that is what the variant perception is as well. So today, most people won't look at this company. I think people prefer the likes of SRF or stuff. But I think I don't. I prefer more basically players who are into a niche, and because triggers for earnings can be really, really strong. So I just did a comparison with PI Industries. So PI Industries, I think a multiple might derate. It has already started derating. And part of the reason is because it's not easy to get into pharma. Every CDMO player has taken a decade to scale the business. You can't just basically dream a plant into existence. And secondly, earlier you get into, beginning it's copycat pharma. It's not you can just get into patented pharma. Right. So initially it is purely generic, and over there, then your margins aren't too great as well. So in terms of comparison with PI, Navin is already in different adjacencies, whereas PI is just stuck in that agro vertical. So it will be very, very challenging. So this is why we are also seeing challenges of getting the scale. And one more challenge is because they've done a QIP of almost 2,000 crores. Entire world knows that they're looking to acquire assets. Even the one is same problem with Saregama, because like entire world knows that you have raised money from the stock markets, right? So whenever the seller knows that you have money, the valuation also inflates, especially for you, right? So that is one of the risks that is there in Saregama and PI as well. So just a brief basically result analysis and right of like Navin. So actually I did on RHI picks as well, like Equitas and HCG as well, but I don't think we have the time to cover more. So any questions that you have, so please feel free.
Yeah, so I have a question regarding the valuations of this, and that's the prime area. So in my view, something gets high PE or high multiples. Basically, either it has very high margins, it has very high barriers to entry, or it has high growth rates. Or upcoming growth rates. There are multiple triggers. Now, in this case, margins wise, it's Navin is doing around 25. Maybe they will, in a good scenario, do 30. When I look at their capex, it's around 600 crores that they have done so far. Maybe they will do more. And in terms of their 3-year top line growth, it's been around 3%. So, is the entire valuation is that this business will do, let's say right now it does sales of about 1,300 crores in a year. Will it kind of double itself or become 3,000 crores in the next 2 years? Is that the source of the valuation that's going through?
That's a very valid question, Tar. So actually, why we saw, so one thing I'd like to take a very wide view is that there are businesses which are going under transformation types. So if you look at a business like Matchtech, so you're really thinking that the business will transform from inside eventually, right? Because they'll get into higher value added, so they'll go into more geographies, and similar case for Laurus, right? Similarly, Navin, when it was transforming, so basically they have this legacy business and the new age vertical business, which is Spec Chem and CRAMS and this HPP business. Whereas the legacy business is the inorganic fluoride business, and I'm just forgetting the name of the other business, but that is a legacy part of the
gas.
The ref gas business. So in that part of the business, they have actually not grown. They've kept the thing constant. Whereas the new age verticals have grown at 25-30% CAGR types in last 4 to 5 years. From starting, so CRAMS business was literally zero in 2011. Now they've built almost $10 million quarterly run rate as of now, which is purely into patented thing, right? And with this debottlenecking, they're guiding the run rate will go to $15 million per quarter. So I think within the mix itself, though sales growth can within the mix itself, the product mix has changed, and Secondly, as you rightly mentioned, so they're doing a capex of 850 crores. If you include the R&D plant, 900 crores ka mota capex hai. Their current net block is of 530, 540 crores. So beyond this, I think even further than this, for new age ref gas, they're looking for a large size capex. For CGMP4, they're looking for a large size capex. More and more agrochemical molecules can move into dedicated facilities, like one has already moved. So this is also one of their things that this can happen. And they're setting up a strategic business unit separately, and which just shows up that they want to raise debt. So it's not just 900 crores ka capex hai, which is going to go live in next 6 to 8 quarters. Actually, even beyond this, the story has legs. So you have visibility for earnings growth beyond next 2 to 2.5 years.
Got it. Okay.
And this was the environment where you really would have seen the challenges of margin contraction.
Yeah.
That didn't happen.
Yeah. Okay. So basically, it's basically a high barrier entry because not everybody can do fluorine at this scale and this advance. And then mostly it's because the runway for earnings growth is very visible for the next 3-4 years. So combine both, and the type of business is kind of changing to a more sustainable, higher margin, high barriers to entry kind of business, which is also combined all three kind of makes the valuations what it is today. And
see, actually, if someone is an investor in Navin today, so you need to keep your expectations in check.
Yeah.
And you can't expect a 30-35% CAGR from these valuations.
Yeah.
Always be a pessimistic or always be a little realistic with valuation. So I was just reading a book where it was mentioned the people who are depressed, they see the reality the most accurately. So a friend of mine is like, if you talk to him over the phone, to sari holdings बिकवा देगा आपको, because he's a depressed guy. इसमें क्या growth है, so this valuation isn't sustainable, and he's running at some goddamn CAGR of 48-49% for last 6 years because he's so valuation conscious.
Yeah.
So his frame of mind is like that.
Yeah.
I need to find something where I'm not paying for growth, and if growth comes, that is an added cherry on the top.
Yeah.
Right. So I think Navin type companies, you can't expect more than a 15-16% or 14-15% CAGR even from even if the earnings grow very high. If it comes on the upside, then you take it with both hands.
Yeah, that's true. That's a problem with all high valued companies.
I have a sort of a related follow-up question on that, Ishmohit. Like you rightly said, if the expectation for the investor is muted because of the current valuation, then wouldn't it make sense? I mean, I'm asking specifically for you, not in general, to deploy that same capital into other opportunities where you're not paying up for growth? Or like, how do you make that decision? What is the framework? Because I'm sure you can find other opportunities right there in your portfolio, which can compound much higher than 14-15%, even in a pessimistic scenario.
Right, that's a good question, Sahil. So the thing is, the allocations are such that the opportunities that I see which are extremely interesting. So if I just talk about this, so some of the largest allocations that I have in terms of the growth, and expectation potential, there are no expectations today out of those companies apart from one. And just allocating more to those companies just makes me a bit uncomfortable because I'm already allocated to like the मतलब इतना allocate कर दिया कि पानी सर के ऊपर से ही निकल चुका अभी तो, right? And now a problem then happens again with your question is that there are three decisions. One is buying, second is holding, and the third one is selling. So if you bought at a cheaper level, now suppose if you bought Navin at 700, 600, then it's a psychological barrier to cut it as well because you really want to see the growth of the company play out accurately. But in a rational world, what you're saying makes 1000% complete sense, that if your expectations of returns are lower from a stock that is richly valued, then in a rational world, you should ideally cut and move to something else because opportunity cost is real.
Thanks.
That's what happens with like everybody who's sitting on at least a position that has gone up 2-3x. Like in my case, IEX, I struggle to sell it. I know it's like at 300. I knew that it's gone beyond any reasonable metric, but I struggle to sell it, and I'm sitting on a 25% drawdown. But because I've bought it at such low price, I would rather see or console myself that I want to see the exchange going forward than rather than sell it and then find something else.
I just a general discussion question. So with all three of you, I think all of you might have also studied a bit of technical analysis. Now, suppose if you're holding a richly valued company, right? And because you're tracking the business, so you realize there will be some very strong headwinds in next 2 to 3 quarters, and you also see a big volume candle with price action on the downside. So wouldn't you think that they're combining technicals with your because in terms of business analysis, you've already done the business analysis, you know it's overvalued. So won't you think that will make sense to book out the gains at that moment of time?
I do that personally. So apart from IEX, I'm doing an experiment. I want to sit on a position for 10 years and see what happens, because everybody tells me somebody should hold a stock for 10 years. So I just want to see that. But apart from that, like in case of Sequent, for example, I did that. I was looking at technicals very closely, and I knew the social media chatter. I knew that the valuations was not going to be sustainable, mostly because they were themselves guiding that nothing's going to happen till FY25. They were saying that we are Rahul Dravid, we are not Sehwag. So they were themselves telling you that we cannot meet your expectations. And so I was looking at technicals, and then I got out. Similar case with RSEL. I know the business is very good, and I know it will probably do well for itself, one of the best auto ancillary companies, but the valuations to me looked unsustainable, and I got out around that. Since then, that's been around 10-15% drawdown since then. So I do that, but in some positions, I'm just for the hubris of it running some experiments, like in case of IEX. But others, I feel like technicals combined with fundamentals can put you on edge. And one of my, like, I consider him like a role model, and like literally go through every video and book of him, Stan Druckenmiller. And he basically says that give me any tool available. I don't care whether you call me a momentum, whether you call me a value guy, whether you call me a technical trader or a fundamental trader. I'm here to make money. I'll use whatever tool is available for me to enable that goal. I don't care whether it's going through 500 pages of annual report, or it's looking at 500 charts.
Right. I think at the end, it's all just about probabilities, whether you're doing technicals, whether you're doing fundamentals, or whether you're analyzing the business. You're just trying to get probabilities in your favor.
Yeah.
So I think so we can conclude this wonderful session, because I didn't even realize that we have gone past almost 2 hours and 15 minutes of time. So I think this was a very good interaction. So I hope to basically do this more often with you guys. And thank you so much for taking the time out.
Oh, thank you for inviting.
Thank you for hosting us.
Yeah, I personally learned a lot from all three of you. So
awesome.
That was pretty good.
Thank you, guys.
Thanks a lot. Yeah, thanks. Take care. Bye.
Take care,
Thank
everyone.
you, guys.